Well, good morning, everybody. I hope you're all well. Not too wet from this horrible, rubbish weather we're having at the moment. And welcome to the penultimate Specialist Mortgage Web Show for 2023. A little bit of an introduction. If you haven't seen one of our shows before, my name's Tony Sutton. I'm the Managing Director of Specialist Financial Services Limited, and I am your host for today. We always, for all the speakers, a little bit of a bio, just basically a little bit about them, what makes them tick, what they're interested in. So this is just really my business bio. I've 6 years of a specialist lender in the early to mid 80s, and subsequently a broker for 18 months. I set up my first commercial brokerage commercial and second charge brokerage at the age of 25 on the 11th of May 1989. Grew this from a two-man operation. At our peak, we had 141 employees, which I absolutely detested with a passion. Because I just became a glorified HR consultant, and just some of the things you have to deal with when you employ that many people is ridiculous. I left in 2004 after a very bitter dispute with my ex-business partner, who subsequently went bust 8 months later. And I traded very, very successfully for 4 years until the crash took all my lenders away, and probably everybody else's lenders away if you were trading at that time. No lack of clients, just a lack of lenders. And if you haven't got any lenders, you can't help the clients, unfortunately. Don't really know anything else, to be honest. I've gone a little bit too quick. No, I don't really know anything else. I've been doing this for so long now that I decided to stay with the market because I knew it would come back. Because let's face it, one thing that we all know, people will always borrow money. Regardless of the situation, all we need is the lenders to actually lend to them. So I stayed with the market, continued trading throughout, and I've continuously been trading since 1989. And here we are today, actually doing pretty well at the moment. Things are very, very buoyant. I've got to say, it's very nice to see after some very worrying times over the last year or so. We also do a claim to fame. This is the last time I'm going to show this, I promise, but I'm running out of things to say on the claim to fame. There's only so many claim to fames you can have, and I've been trying to keep them each one fairly unique, except for this one. So on the 20th of September, those of you who watched last month, I said that on the 20th of September, I'll be celebrating 40 years, or not celebrating. I was actually in Rhodes on holiday, first holiday in quite some time. By God, did I celebrate a little bit too much, according to my wife, and lost the next day completely. But 40 years I've been doing this, which scares the living daylights out of me. It really does. But so I've seen quite a bit over the years. A lot of lenders come and go, a lot of people come and go, but that stand me in good stead for some things we'll be talking about a little bit later when it comes to what we can do, what we can get through. Okay, so today's sponsor is a big thank you to Roma Finance, who have sponsored today's event. If you can't hear or see us, might sound daft, but sometimes it does happen. Go to the type your message box in the bottom right corner and let us know, and we'll try and sort it out. My IT team will try and sort it out for you and probably give you a call if there's an issue. If you are one of the very, 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 very few people still using Microsoft Internet Explorer, you will experience problems, mainly because Edge sometimes causes a problem because Microsoft don't like companies using anything other than Teams. So already our software that we use has been, I'm not saying compromised, the wrong word, but Microsoft have done a few things that have made it more difficult to use. So over the past few months, but we don't like Teams, so we use something else. But you will have problems if you use Internet Explorer, believe me. So switch to something else. And as I always say, please bear with us because we are depending on outsourced technology. Our office building is notorious. When it rains, we lose our basically we lose our internet signal. It can sometimes just drop out. So if something does happen, bear with us, we'll get it sorted. There are various ways we got around this, but it might take a couple of minutes to fix. If you have a question, again, go to the type your message box in the bottom right corner, and we will try to get to all the questions in the time we have today. If we do miss a question, please forgive me. It's just sometimes it's very difficult to keep an eye on the questions at the same time as talking. But we will try and get to every question that is asked. And if we don't, then we'll come back to you afterwards and hopefully with an answer. Today's specialists, there's the pictures of them. I was trying to think how to actually work this today, actually say this, but as you can see, it's an all-female lineup today. So I'm the lone male as a speaker today, so I'll probably be completely outshone by these ladies. I will go into, obviously you can see there, Claudine, Grace, Tatyana and Shay will be speaking today. And just in case you're not quite sure which lenders they're from, there we have Roma Finance, our first up, that's Claudine. Grace from the Family Building Society, Tatyana from Lendinvest Mortgages, and finally Shay from Allica Bank. And today's objectives, as always, obtain a more detailed knowledge of different lenders within specialist finance. We're not the company that will have 4 bridging lenders all speaking for 3 hours, because I see that as absolutely pointless. So we've got one lender covering specialist buy-to-let. We've got one lender covering commercial mortgages. This is where you realise you haven't checked your slides properly the night before, because we don't have, it is Resi first charge, and we have bridging loans. And I will be talking later on about second charge mortgages. So I saw something come up there and I thought I haven't changed it, but I have. So that's all 5 subjects that we really cover, all 5 products that we really have here will be covered in today's sessions. Each presentation lasts approximately 20 minutes, and there's a 10-minute Q&A after each session. And the speakers have set themselves questions. I already haven't gone through their presentations. I can see that a couple of the questions that could be asked have already been covered in their presentations. So please, 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 please ask as many questions as you like. There's no such thing as a stupid question. Please ask away, because that one thing that you do actually type into the box could be the thing that 20 other people are thinking about, but maybe too shy to actually put it in there. So please ask questions. Don't give them an easy ride. I'm still waiting for a question to be asked that a speaker then goes, oh, no idea at all about that. So as long as it's relevant, please ask the questions. Feedback and CPD. Feedback questionnaire will be automatically available at the end of today's show, and we'll ask questions about today, how you found it, what we need to improve, what you'd like to see in the future. We're trying to put as many of these on as possible. I think we're up well over 50 of these now since we first started in 2020, and probably over 100 since we started, because we originally started out on the road with these in 2017. It's a lot easier doing them in front of the computer in a quiet office rather than traveling up to Newcastle or down to Exeter. So we tend to do these online now. We're not planning to do any out on the road in the future. But what do you want us to do to improve it? What do you want to see in the future? This is really important. It also asks you to rate each speaker for their presentation. Of course, we want to invite people back again if they are popular, if they do a good job. If someone doesn't do a good job, or there's a problem, you find you have a problem with them, let us know. You can keep it anonymous if you wish, entirely up to you, but let us know. We do need your feedback. And the CPD will be emailed to you by 5:30 tomorrow. Please check your spam if not received. I think I mentioned last month, we normally get quite a few phone calls from people saying, I've not received my CPD. And my first question is, have you checked your spam? No, I haven't. And guess what? It's sitting in the spam folder. So if it is in your spam folder, add us to the safe senders list, and that way it won't happen again next time you attend one of our shows. Our update guide is now available to our product commission and prop fees. It's downloadable. You can download this from the website, or I will show you how to access it at the end of today's show. And our GDPR, how to be compliant. And we've been offering these since 2018, since I think it was June 2018, just after GDPR first came into force. If you've not done anything on GDPR, and believe me, there are probably still about 50-60% of business owners in financial services have done nothing on GDPR at all. And you probably think nothing will ever happen. The only thing I would say is, if anything does happen, if you do get hacked, if there is a problem, you click on a dodgy email and something happens, and you are obliged to report it to the FCA and the ICO. Otherwise, you could be fined a lot more than if you do report it. They will come down on you like a ton of bricks if you haven't done anything at all. At least if you've done something. So these particular checklists, which I copied from the ICO website all the way back in May 2018, when I stumbled across them, because they'd not been advertised as something you could do. And I thought, that's a good idea, but they weren't fit for purpose. So I just copied and pasted it, put it in a document, did it ourselves. We do the second one, the annual assessment, every year. These are downloadable from our website, and it at least then shows anyone that comes in because there's been a problem, and they will ask what you've done, believe me, because I know, and they will ask what you've done. And if you show them you've actually done something, you do something every year, it will take the heat off more than anything else. So if you haven't done anything, I urge you just to spend 5 minutes of your year just ticking these boxes, then keeping it somewhere safe. Something else we knocked up, consumer duty, still a big topic, still seeing lots of stuff going on. I'll be covering a couple of slides on this in a moment. I don't know if you remember, probably, I think it was about 3 days after the deadline of the 31st of July, we had, I think it was 3 or 4 lenders decided to issue a guidance to vulnerability, which I thought was probably about 6 months too late. Why issue it afterwards, not issue it before? Which was actually, I think, was originally issued by UK Finance to lenders, obviously not brokers because we're not worthy, even though we're the ones at the sharp end who are trying to obviously discover whether a client's vulnerable or not. So this is the guidance, not just what is a vulnerable customer, but also what to do, which is probably a lot more important because sometimes it's not obvious. So that's full of stuff, and I'm not going to stake any claim to having designed this at all. Again, I'm a great believer when it comes to things like this. Nick it off someone else, which is exactly what I've done. So I've combined all the good stuff from these lenders, put it into one document. I think it's about 12, 14 pages long. And it gives you an idea of exactly what you need to do on clients and what you need to look out for. And it's also very, very handy for your staff, if you have staff, just so that you can actually, you can see there, this is an example where my staff would actually read it and sign it, probably on an annual basis. And again, I can show FCA come in, do a visit, right, what are you doing on vulnerable customers? Okay, we've done this, we've done this, we've done this. This is how I do part of my training with staff, just so they recognize what a vulnerable customer is. And it's like, oh, okay, it's a good idea. Great. That's all you need, basically. If you need that, I see there's lots of people put VC. We will get this to you a little bit later on today. It might actually come over to you this morning if my IT team get the chance. But it's very, very useful, incredibly useful. I did cover this last month. I'm probably only going to cover it again this month because of what's coming up in a couple of weeks' time. But this is actually quite topical. 1 in 10 financial advisors consider quitting due to consumer duty. I'm probably speaking to a person a week at the moment who is been generally people that have been in the industry quite some time and are just absolutely sick to death of what is being forced upon them now, and they're just thinking of retiring. So we now have quite a few people who are in the process of retiring or have retired, but still have their clients phone them up. And guess what? They're still earning from deals because they're just now passing those leads over to us. And still earning very, very decent money. We have one broker partner who was a mortgage. I mean, he's in his late 70s, early 80s now, who has been in the industry for donkey's years. Retired 4 years ago because he was just a bit sick of it and all the regulation that was going on. And he's now earning more money than he did when he was fully involved. And all he does now is he receives calls, passes them over to us, we complete them, he gets paid. So if you are considering retirement or moving away from the industry, we can have a solution so that you can keep earning. So just a little bit on this, there was a core data study, it's only 267 financial advisors, 11% are considering leaving the industry or retiring because of consumer duty. And it also shines a light on how regulatory pressures are affecting mental health. No one ever talks about advisors' mental health, do they? It's always a client's mental health and, how we have to look after clients, how we have to look after their vulnerability. Well, what about the financial advisors? We're the ones at the sharp end. We're the ones who are sitting up till 2 o'clock in the morning, getting stuff done. We're the ones who, like I was on Sunday night, working at 10:30 to get terms over to a client. They don't actually recognise this, I think, the regulators at sometimes. 35% say regulations are negatively impacting their mental health, which I think is quite disgraceful. Because we do have regulations that are forced upon us that really are written by people who have never sold a mortgage in their life. And it's as simple as that. So how can they actually set rules when they've never done the job? Who's going to pay? 46% think new regulation unnecessary burden for advisors and will do more harm than good. Less than 1 in 5 disagree. And of course, who's going to pay for it? Well, who do you think is going to pay for it? Customers are going to pay for it, as they always do. So there's lots of advisors that are thinking of actually increasing their fees because of the amount of extra work they have to do. And whereas the FCA are saying, hey, we'd have to justify our fees. Well, you've brought out rules that really have just increased the workload for us mortgage brokers massively. And let's face it, we're not offering investments to people. We're not investing hundreds of thousands of pounds of their hard-earned savings. We're sorting out a mortgage, and we all do pretty much a bloody good job at it. But regulation treats everybody the same, of course, and we're all in the same boat. So massive increased regulation and what we have to do. And of course, who's going to suffer? Clients will, and the others that suffer are the ones who can't afford the advice because the prices have gone up. So what they do, they go to the big banks, of course, which is where half the FCA directors end up when they retire. But that's another topic entirely. So just on the topic of Consumer Duty. For those of you who saw Robert Sinclair back in May, I think it was, basically talk about Consumer Duty. It was our most successful and most highly attended seminar we've ever done. He will be doing the follow-up. How did it go? And just talking about basically what the FCA, because this is a man he sits at the top table as such. He's the one that meets with the Treasury. He's the one that meets with the Bank of England. He's the one that meets with the FCA. He's the one that knows exactly what's going on. This is in 2 weeks. It's an hour long. We'll show you how to register at the end of today's show. It is available on our website. You just click on the Sutton and the Specialist box at the top. But I would say don't miss it, because there will be some nuggets in there that if you're a directly authorized person or you're an AR, that you're going to want to hear. So first presentation's about to start. I'm really hoping that our first speaker is in the room. I've not checked, but I'm sure they'll appear in a moment. Get yourself comfortable, and as soon as they do appear, yeah, she's appeared. Excellent. We will start. And there you go, seamless. So Claudine is about to appear, I'm hoping. She's in as a presenter. Just need her microphone and camera on. I'll start the introduction very slowly, just in case there's any problem, because we are bang on schedule at the moment. So you should receive this morning from us, which is Roma Finance's product guide. That's gone to you by email this morning. A little bit on Claudine. She's the business development manager for Roma Finance, based in the north of England, with a focus on this area and Scotland. Claudine, who has a wealth of expertise in the financial services market, has spent the last 5 of her 20-year career as a commercial broker. She is dedicated to providing support and tailored solutions to Roma partners. And I know Claudine's in the room because I've just heard a noise from somewhere. Claudine, can you hear us?
Most certainly am. Good morning.
Perfect. Brilliant. I like it when it goes like this. And Claudine's claim to fame: Claudine plays football and recently captained the Bury FC women's development team. Very well done. There you go.
She did.
Bury was the team that went bust, wasn't it? A few years ago.
Totally, that's not a way to introduce it, but yeah,
well,
it was.
They had some financial problems.
They did have some financial problems. They are back and kicking now.
But they're back. Good. Okay.
They are back and kicking.
They've been around about 140 years now. Something.
A long time. Yeah. They've been around a long time. Yeah.
Okay.
Fab, thank you. Good morning, everybody. Morning to Tony, and thanks everyone for having Roma along today. We're delighted to sponsor today's event. I think probably best start with you. Please give me great feedback, because I would like to come back. And if that's the only measure from today, then if you can give me great feedback and I get invited back, then that's all good by me. Okay, so I guess
just going to stop you. I'm going to go for 20 minutes. And okay. I'll see you in 20 minutes. So you're on your own. If there's any problems, I'll pop back in. All right?
Perfect. All right, let's go.
Problem.
Okay. Right, he's gone. So there now is only us. So great feedback only, please. That would be amazing. Okay, guys. So I guess probably the best place to start is, who are Roma and what do we do? So Roma's a bridging and development finance lender. So what does that mean? We lend on development finance where there is something new being created where there wasn't before, so ground up development. And we also lend on bridging finance, which is easiest way to describe it is a bridge between the purchase of the property and what the final goal of the property is. So that's Roma in a quick nutshell. We lend on a borrower first basis, and I'll go through that in a little bit more detail as we go through the presentation. We work with partners to provide finance to landlords, developers and investors for the purpose of adding value to the property, and that's really key. So we look, when we're lending funds to borrowers, we look to make sure that they're increasing the value of that property. So we don't tend to look at standalone asset finance. It's purely where they're looking to increase the value of the property. So that works really well on flips, on when they're buying off market, they're looking to increase the value of the property by refurbing it and either keeping it or selling it on at the back end. So that's what we do, and that's how we do it. But you'll know that there are now millions, probably millions of bridging and development lenders in the marketplace. So when you're looking around the market to look at bridging and development lenders that you want to work with, what are the key things? We try to kind of help a little bit and add value when we're doing presentations like this. So what are the key things that you should or could be looking for in a lender when you're looking around the marketplace? Because doing your due diligence on a lender is just as important as when we do due diligence on the borrowers that we're looking to lend to. So quick list. So the due diligence you could look at is, what's the size of the company? How long have they been going? Look into the background of the owners and also the underwriters. So how long have they been underwriting? What's their mandate? Who are the owners? Why did they set up in the first place? What's their background? How many funding lines do they have? Is it their own funds, or is it funding lines that they're using from bigger institutions? Where does their funding come from? So is it bigger institutions? Is it their own funds? How long does it take to get drawdowns? So if you're buying off market and you're looking to do the works, and we're funding, or a lender is funding a percentage of the purchase and also the works to that property, how long does it take to get those drawdowns? So if you're sending someone out to have a look at the property, how long before they get the funds? Because that's going to be really key for the borrowers and their builders when they're on site. What happens if you need more time or more money? Is there capacity to do that? So when the lenders are underwriting deals, are they underwriting it with a view to, if something goes wrong, do we have the ability to help the borrower get out of this situation, however that may be? There's a little quick stat there that almost a quarter of borrowers do get into some kind of issues where they need more time or more money. And I think certainly over the past 2-3 years, especially in development finance, we've seen this incredible increase in build costs, in labour costs, and therefore in timescales, and therefore a lot of borrowers have had to extend facilities. So you'll see a lot of development exit products in the market at the moment, which is where developers have run out of time or have run out of funds. The development lender are now looking for their funds back, and that's where people like Roma and other lenders can help and support and step in with a development exit product. And how many loans have they defaulted on or repossessed in the last 12 months? So again, when you're in the market, you'll see that there are lenders out there who look to repossess or look to default straight away, and there are other lenders who look to work with borrowers and support them through that next step. So that's just kind of and these slides will be available at the end, so you don't need to write them all down. But it'll help you when you're doing due diligence in the marketplace. So keep that in mind when you're looking for bridge and development lenders. You would think they're all the same, but they're not. As we kind of mentioned previously in my background, I've done broken as well as working for a lender, so I'm well aware that there are some really great lenders out there and some who are less great. We'll go with less great. I'm hoping that the feedback's running really well right now, guys. 10 out of 10, please. Okay, so we talked right at the very start about borrower first. What does that mean? So if Roma's lending on a borrower first mentality, what does that mean? It kind of means two things, got two hats. So the first point of that is that when we're lending, we look at who we're lending to before we look at the asset. And that's really key. You'll find a lot of lenders look at asset first, and predominantly only asset, and they'll maybe do a credit check on the borrower. That's pretty much as far as it goes. We're entirely the other way around. So we at Roma like to build relationships with brokers and with borrowers. And the way we do that is by understanding the people that we're lending to. So we very much like to go out to site. We like to meet clients. We like to go out for a coffee. We like to understand them. We want to understand what their goals are. We want to understand why they want to do what they want to do. And understand the borrower, and this particular slide is fundamental to the way that Roma lend. So when we're talking to you about what the particular transaction is that you're looking at, we will want to know what is their motivation. So why do they want to do what they want to do? What's their background and experience? We can lend to first-time borrowers, first-time developers. What we're looking for, if we're looking for that kind of, if we're looking at that kind of borrower, is what kind of experience of the team have they got behind them? What's their background? And we'll talk in a minute about Roma personas. Try saying that when you've had a couple of glasses of wine. So Roma personas is the type of people that we like to lend to, but we'll talk about that in a sec. So what's their background and experience? What do the costs and timescales look like for the project that they're putting in front of you? Are they realistic? So let's say you've got a borrower who wants to buy off market. He's buying a 3-bed terrace, wants to create it into a 6-bed HMO. If he's coming to you with 30 grand's worth of build costs and a 6-week timescale, it's just not going to happen. Like, we all know that that's not going to happen. And specifically, we all know that trying to refinance a 6-bed HMO at the moment is not going to happen quickly. There's a lot of lenders out there who are taking their time with refinances in particular. So we would be looking at a 12-month facility without a shadow of a doubt with that kind of transaction. We're also probably looking sort of 50 grand, 60 grand, 80 grand more in terms of refurb costs. So when you're looking at it, just do a gut feel. Does it look realistic? And if you've got any questions, that's where we're around to take those questions and to help you and walk you through that transaction. We don't expect you to come to us and for it to be 100% packaged and ready. What we look for is for you to have an idea of, yeah, this fits. We think it's a Roma kind of borrower. Let's give Claude a call. Let's give someone at Roma a call and talk through it in more detail. That's what we do. That's what we're great at. And critically, when we're talking specifically about bridging, what's their exit? So do they want to refinance, like we just talked, on an HMO or a long-term product? Or do they want to sell it? In which case, have we built sale timescales into that initial bridge time? So you'll know with bridging, it's anything up to 24 months. At the moment, predominantly, we're writing anything up to 18 because we talked about before, do lenders look to repossess or default? We don't. But because of that, because what we'll do is we'll try and shorten the timescale to 18 months so that we know that we've got another 6 months in our back pocket, essentially, just in case there is any problems. So we can go up to 24 months. We would typically look at no more than 18 so that we've got another 6 in our back pocket just in case we need it. Next slide. So what does a Roma borrower look like? We talked about a couple of glasses of wine and Roma personas. So we have 3 different types of people that essentially we love to lend to. The first, experienced property professionals. So these are guys or girls that have done it time and time and time again. They buy well, they buy off market predominantly because they have a number of contacts who send them off market opportunities. They've got experience of flipping, keeping, flipping, selling, developing previously. That's kind of your experienced property professional. Number 2, a successful individual in another field. And what we mean by that is somebody who has been really successful in a totally different field of experience. So that could be doctor, dentist, lawyer, accountant, anything like that, where they have proven that they have experience and qualifications in a totally separate field. One of the best borrowers, repeat borrowers that Roma have is a project manager. The guy has done IT projects for years and years and years. He is now probably one of our most successful developers. We know that his costings, when they come in, are pretty much bang on. And he's developed that relationship with us. We would probably now call him an experienced property professional as well. But when he came to us originally, he was a successful individual in another field. Or someone with assets in the background. So high net worth individual, got assets in the background that we know they're able then to support themselves should anything go wrong with this transaction. So what are we looking for? So when we're looking to underwrite a case, when we're looking at the transaction that you're sending in to us, what are we actually looking at? We're looking at, are they likely to achieve their objectives? So that whole cost timescales piece, we're looking at the stuff that we've done recently. Does it sit within those kind of parameters? Is there profit in the project for them? That's massive. So I don't know anybody who's got experience in development, but certainly a lot of the development projects that we've seen over the last 12 to 18 months, the profit margins are reducing because the labour costs have increased, the material costs have increased, but GDV just hasn't increased that much. House sales just haven't increased that much. And therefore, the profit on the project just isn't as much as it has been previously. That said, everybody's in it to make money. So we want to make sure that everything's realistic so that they can make profit at the end of the project. If something goes with them, can we work with them to resolve issues? So we look for borrowers who are open, who have communication, who want to work with the broker and want to work with ourselves to make sure that if there are any problems, we can all work together to resolve it. And alongside that sits complete transparency. So we work really well with borrowers and with brokers who are completely transparent. Don't hide stuff, because we have great underwriters who will find it. But also, be open and transparent with us. That's what we want. If you think you're going to come across an issue, call it out. That's what we like, and that's what we work really well with. So our products, what kind of products do we offer at the moment? So we've got standard residential bridging. So that's just a bridge from start to finish. So that is where you might be buying off market. You want to you're going to flip it straight onto buy to let. That's where our standard residential bridging comes in. To the right, I've got refurbishment bridging project finance. Good God. Refurb bridging finance. So that's where you're buying off market. You want to do some refurb works to it, and you want to refinance that at the end or sell. With that particular product, we can do a percentage towards the purchase, and we can also do 100% of the works. So if your borrower's buying, or you're buying for 100 grand, you've got 50 grand's worth of work to do, and you've got a GDV of 200, 250 at the end, we can do 70, 75% of the purchase. We'll do 100% of the works, excuse me, in arrears, in tranches, with a view to that GDV being subject to valuation at the end. We will do commercial bridging. So if it's commercial property such as office blocks, retail units, warehousing, anything like that, anything that fits in the commercial space, or indeed in the semi-commercial space. So we do semi-commercial bridging as well. Development finance we've talked about slightly, with which is ground up. So that's where you are creating something new that hasn't been there before. It may well be that they're buying a property, demolishing it and building something new. It may well be that they're buying land and they've got planning to develop it up to houses or commercial development, whichever. Auction finance. So those of you who are experienced at auction, you'll know that there's a time limit. As soon as the hammer goes down, you've got a certain time frame in which to complete your purchase. We can work really quickly and at speed to make sure that happens. So auction finance is one of our products. And developer exit, which we talked about just previously, where the borrower is close to finishing wind and watertight a development. Development funder is now looking for their funds back, and we would typically do a short-term finance to exit the developer and exit the developer funder and give the borrower some more time to finish that, market it, sell it, refinance it, whatever it is that they want to do. So yeah, typical kind of rundown of our products there. So Roma Flow, you may well or may well not have seen that we have recently launched some new products at Roma. One of those is Roma Flow. So Roma Flow, what can you expect from us in terms of Roma Flow? So intelligent touch underwriting, we have physical human underwriters who are very good at their jobs. They've got a lot of experience. They like to take a view where they can. We don't like to say no. We're a lender. We're here to lend. So we don't like to say no. We like to take a view on things, and we like to say yes where we can to anything that we can. Reduced document requirements. So it's a very small shopping list. So if you come into us with a flow deal is a standard resi bridge or a light development residential bridge. So that's where you're doing less than 25% of the current market value in works. So 100 grand, you've got 25 grand's worth of works, that'll fit on our flow product. So reduced document requirements, very small list of document requirements if your case fits Roma Flow. Solicitor instruction within 24 hours. We can do desktop valuations, which is a full valuation, but it's on a desktop. We don't need to get a valuer to come out and see it. Dedicated underwriter and case processor. Our underwriters are brilliant at picking up the phone. So we don't tend to email, we'll tend to give you a call, we'll talk about the case. We'll make sure that we're on the same page as you, and then we'll crack on. You will know who your case underwriter and case processor are. And if you have repeat clients, repeat borrowers, we like to send them back to the same underwriter, same processor. So they have a great experience because they know who they're talking to. Cutting edge technology and a streamlined process. We use electronic as and where we can. So we accept electronic signatures. We use open banking. We use CREDAS to make sure that we can check ID and proof ID. So everything that we can do electronically, we will. And our investment moving forward is through technology. It's not through people. We don't want to increase headcount. We want to increase our efficiency and how we do things. If the client's credit report checks out, we don't need bank statements. So long as we can see what they've got on their credit report, then we're comfortable with that. We don't need copies of bank statements. And again, that's where open banking can help. And 80% of cases are completed in under a month with Roma Flow. So we look at 4 weeks as a maximum, which really helps with things like auction finance and when they're buying off market, because off market transactions tend to want cash buyers. But if you can prove that you can get your finance done in 4 weeks, a month, then so be it. Let's get on with it. So what do these products look like? So 2 different types of products here. We talked about flow products. So we've recently launched these, and it's a tiny little point underneath the box, but actually it's a really big point, and I'll cover it in a second, which is about exit fees. So Roma Flow Bridge, so standard bridge starts at 0.9% up to 75% loan to value. So that's 0.9% a month. Standard 2% in, 0.9 a month. Exit fees we'll cover in a sec. Flow refurb, which is what we talked about before. So cost of works up to 25% of the current market value. A lot of lenders, bridging and development lenders, when you're talking to them, they'll talk about the types of work that you're doing to the property, and that defines whether it's light, medium, or heavy. We don't look at that. We look at the cost of the works versus the current market value of the property. So anything up to 25% of the current market value in cost of works, that fits on our flow refurb product. So that starts at 0.93% a month, and again up to 70% loan to value. Desktops available. Light development, cost of works between 25% and 50% of the, hang on, that flew back then. 50% of the current market value, 0.9% up to 70% loan to value. Roma Flow products, if they're refinancing, then there is no exit fee as part of this product. If they are selling, then there is a 2% exit fee. So really critical, if they are going to keep and retain that product and it fits on one of our flow products, there is no exit as part of that. So you could be looking at a client at 0.9% standard bridge up to 75% loan to value, no exit fee, which if you're looking around the market, you're doing your due diligence at the moment, that's a pretty good product. The other products that we've got at the moment that sit outside of our flow bridges, so we've got medium refurb, so between 50 and 100% of the current market value in works, 0.99% up to 70% loan to value. Heavy refurb, cost and works is more than the current market value. That starts at 1.05. Commercial, 1.25, up to 65% of the market, 65% loan to value. Semi-commercial, 1.07. Developer exit, so this is where it's wind and watertight that we mentioned before, 0.93% up to 75% loan to value. And below market bridge. So below market value is where they're buying off market and it's below the market value. There's a couple of pieces of criteria that sit behind that. So we want to see that they've done it before. So we'll want to see that they've done it at least 3 times in the last 24 months and made profit from it. So 0.99% up to 70% loan to value if they can show that. And again, more than happy to work with them on that.
This bit's me.
Right, good. Because I was looking at it thinking that is not my slide, Tony.
No, it's not. No, it's one that I did last night. So what I've decided to do,
nice
delegates that have been on have attended our shows before, at the end of each lender presentation, I'm going to do a quick case study for you, so you can see a case that, in this case, it's a case that's about to complete. The other three are cases that have completed. And we do have another Roma one later on that's now completed twice, which we always cover because it's a great example of the flexibility of a lender. So
Nice.
this basically, this was a client that was introduced to us by, I mean, the broker partner who introduced this to us has probably been putting business to me now for about 25 years. This case came over, and electrician, since pretty much he left school, he's now in his sort of early mid-30s, and had worked on developments before as an electrician, and also helped his brother to complete a development, but this was his first on his own. He had a fairly substantial amount of money put aside, a mortgage-free property, which he was going to demolish and rebuild and turn into something quite special. And so we put this initially to 3 lenders, including Roma, and Roma came back because we are a packager partner of Roma, packager status. Not only were they far cheaper than the other 2, but also they were paying us double. So it was a bit of a no-brainer as to who we were going to use. So this is one that is now been offered. He's on with legals, with solicitors, all the usual nonsense, but it should be fairly quick because the property is already owned and it's mortgage-free. Broker partner will be earning £7,260 on the day of completion, and that's a guarantee. So that's just an example of not only the flexibility in the lender, but also if you do use someone like, put a deal through someone like ourselves, you will earn the same as if you go direct. But the second point is those slightly trickier cases, it's all about how it's presented and knowing what to present and knowing what the lender is going to look at. And it's always best that they get everything in one go rather than they get it sort of like on a drip basis. And because we want to impress them with the deal right at the outset and then go, yeah, this is one for us. Let's issue terms. So it's exactly what we've done on this, and say that's now gone through. There hasn't been any hiccups at all on this. I'm pleased to say, touch wood or touch Formica, and just down to solicitors now. So this is probably where we get the delays. So that's one example. I'm just going to move on to the next one because this is now the questions one. So we're doing these these case studies before the questions, and I believe. No, Claudine, you did say, can anyone give you 10 out of 10? Unfortunately, on the thing, they only score you out of 5. So if anyone does give you a 10, I'm not quite sure what to do.
I'll take it. It's double scores.
Jay has said 12 out of 10. There you go. You've just seen that. And there's some this. Right, okay. So questions, none asked by the delegates. So I'm going to ask you the questions you've set yourself.
Oh, God, one of them was really complicated as well. I remember writing it. Go on.
How does funding for the building works work?
Oh, okay. Yeah, no, that's not the complicated one. The middle one's the complicated one. Okay, so funding for the building works works like this. It's in arrears, in tranches. It's very much like development finance. So if you need 50 grand for the building works, you start out with your, let's say 10 grand. You spend your 10 grand. You get your invoices for that 10 grand. You show us the work that you've completed. We'll send someone out to site to have a look. If it's under 500 grand, it's usually someone like me or someone from the office who'll come out, have a look, take a few pictures, send it back to the underwriters. The underwriters will review the invoices versus the pictures. And then, I'm loving all these 10s out of 10s, by the way. And then we will refund the invoices that you've spent so far. So that 50 grand then comes in arrears, in tranches, as you spend it through the project. So you use then the invoices that we've paid to crack on for the next one.
Excellent. Okay. I'm going to leave that middle question to last now that you told me.
Yes. Brilliant.
What does borrower first lending mean?
Oh, okay. Oh, I kind of covered that in the presentation. That's all right. So 2 hats. We want to know who the borrower is. We like to understand them. So we want to go out for a coffee with them. We want to see them on site. We very much like to work with brokers with their borrowers. So I went to see a site in Bradford the other day with the broker, with the borrower. So it was very much a 3-way conversation. How can we support the broker to support the borrower to get the project completed? So that's number 1. Number 2, we'll underwrite the borrower first. So we don't do static asset lending. We like to we'll underwrite the borrower first, and then we'll look at the asset second. So both of those pieces.
Okay, someone was typing, but it hasn't come up yet.
It was just to say 10 out of 10, I'm sure.
Final question. I'm only going to give you 5 out of 5, by the way.
Sure,
What's
yeah.
the difference in how the interest is calculated between the day one deducted and the interest for the works?
Yeah, so it is actually quite an important question. So if you're doing a refurb bridge, there's two types of interest that will be calculated on the transaction. So the first is deducted interest. So if you've got a 12-month product and we're doing 12 months deducted, we will take 12 months worth of interest off your day one drawdown. So 12 months worth of 1%, for example, on the 12 months drawdown will come out of the initial day one drawdown. The interest for the works is calculated as compound interest. So that's rolled up as you go through. So the amount you draw down is the amount of interest that you pay on those drawdowns. So you've got deducted interest, which is off your day one drawdown, and then your compound interest is on the works that's in the background. Does that make sense, Tony? Did I explain that anyway?
Yeah.
Oh, God, thanks. Thank God for that.
That's absolutely perfect.
Okay.
Someone is
typing. Made so much sense in my head.
Just whilst we're waiting for that question to come out, something I'm going to say about one of the things you touched on earlier on, I'm glad you mentioned it, is the due diligence. Now, we all know when we go to a lender and we say, right, I'd like to place business with you, they do lots of due diligence on you. Some lenders, it's fairly light touch. Other lenders, it's like applying to the FCA for authorization. We're actually the same. We will do, when we are looking to bring a lender on board, we actually send them an application form. That's actually the best way to describe it.
I like that.
And the reason we do that is we want to ensure that, we then look into the background of the people behind it. I want to see if they've got a string of failed bridging companies behind them. I want to see basically what their track record is. But the main thing I want to see is where they get the funding from and what they would do when a deal goes over term, as Claudine mentioned. And that's absolutely vital. There are a number of lenders out there whose entire business model is based on the clients going over term, because that's where they make their money. They tend to be in the peer-to-peer space. They're paying away so much money to their investors that their profit margins are so thin. It's when that client goes one day over term, it's like, okay, there's a 35 grand fee you've now got to pay us. Your rate's now increasing to 4% rather than 1% per month.
Yeah.
And absolutely, we've seen some horror stories over the last 3 years, especially during COVID, where there was no leeway whatsoever being given to these customers by these particular lenders, who had no hope of actually refinancing at that stage because the entire country was in lockdown.
Oh, it's a nightmare. I was a broker during lockdown, Tony, so I feel your pain. Tony, that's a really good point, though. Maybe we could add to that list what was their status during COVID, because there were a number of lenders, you'll know, that just pulled everything. The rug from under people's feet when they were days from completion. So what was their, how did they deal with COVID, and did they continue lending? I'm delighted to say that Roma continued to lend throughout COVID. Just quickly, Rory's just put a question in: do we charge a non-utilization fee for funds not drawn? No, we don't. So no, keep that. No.
Okay, no more questions. Claudine, absolutely fabulous. Thank you.
Thank you.
I'll give you 5 out of 5. There's a few 10s out of 10. So
if you can feed that back to our head of marketing as well, that would be amazing.
I don't actually. I always report back on all speakers to the MD. I've known Scott for many years.
I mean, he'll do either way. He'll do.
So, obviously, good or bad, I have to, because obviously it's very important as a business owner. You know how your staff are doing. So, but it's very rare that I have to report back. But quite often we also find that the MDs of various companies actually watch how they're.
Can I just take a screenshot of that last bit? Pay rise, 100%. Yeah, you feed that back as well for me, Tony.
I can feed that back. I can imagine what Scott's going to say. Right, okay. Claudine, thank you so much. That was excellent.
You're welcome.
First time with us, but we will be inviting you back. I thought that was brilliant. Thank you very much.
Thank you.
Don't exit.
I'm not doing nothing, Tony. I haven't touched a thing.
Don't touch any keys, because you could close down the entire show with one click. So that will be done for you. I will not
do that. Thank you.
So we move on to our next speaker, who is a regular speaker with us and also did a Sutton the Specialist earlier on this year. And there you go. There's the slides. So I'll speak slowly until she appears. And here we go. We have Grace Bennett from the Family Building Society, with whom we have packager status. So we have access to lots of semi-exclusive products that you can't access directly. And you would have received this. Their marketing's a bit funky, as you can see. This is there's nothing normal about our family. I'd probably say at least 2 of those people on there look like members of my family. So whether that's normal or not, I'm not quite sure. But you have got that by email this morning. So Grace has been working in the financial services industry, for 6 years. Her hobbies include socializing, traveling to new places, and binge watching the latest thriller series on Netflix, which, as you can imagine, takes up quite a bit of her free time. She also loves meeting new people, which is why she enjoys her job so much. Her claim to fame: Grace was in New York waiting in line for a pizza. Love the pizzas in New York. And Catherine Tate was stood in front of her. They had a brief conversation. She was just as funny and was telling Grace about her, at the time, upcoming film. Did she do any voices, or did she go into Nan mode? Or
No, she didn't. I wish she did though, because that's just brilliant.
You're a bit quiet, Grace. Your mic. Can you move your mic a little bit closer? You're a little bit quiet.
Can you hear me better now?
A little bit, just maybe a tad more.
Let me see. How about now?
That's better. Perfect.
Yeah.
Okay.
Perfect.
Before Grace starts, I always say this when Grace appears on our shows. Grace is probably one of the most productive and best BDMs that we have the pleasure of dealing with. We all know sometimes BDMs seem to, the business development manager that you can never contact is not actually developing business. Well, Grace, I can assure you, is not only great for us, but we also, she also is happy to take calls directly if you have a case. And details will appear a little bit later on, but she will take calls directly, tell you whether a case is doable or not. So you can, obviously we want that case to come through us because we'll pay you the same. And of course, we got that experience that you may not have with Family Building Society to get the deal through. So Grace, over to you. I'll see you in 20 minutes.
I'll see you shortly. So good morning, everyone. I hope you're well on this pretty miserable, rainy morning, but hopefully after today's presentation, you might be feeling a little bit better, and there might be some cases that you've been struggling with recently that you can find a home for after today's presentation. So for anyone who isn't overly familiar with the Family Building Society, I thought I'd just give you a really quick insight and tell you a little bit more about the background of the company. So as it says there, who are Family Building Society? We provide mortgages all different clients at all different stages of their lives. We lend to first-time buyers being at age 18, to lending right into retirement to clients in their 90s. Now, anyone who's been in the industry for some time may also know us as National County Building Society. Now, we rebranded from National Counties to Family in 2016. Now, the reason for the rebrand is we wanted to keep that traditional underwriting approach that National Counties was always known for, but put that modern day twist on it. So hence, being named the Family Building Society, we do a lot of intergenerational lending. Now, you can see on this slide here the areas of lending that we specialise in. And I've mentioned that we lend to older borrowers into their 90s. We look at a lot of interest-only mortgages. Now, whilst we're primarily a residential lender, we also do a small area of buy-to-let lending, but today I'm just going to be discussing our residential criteria. We do look at expats. We definitely take a sensible approach to self-employed applicants, those are some more quirky and bespoke company setups. And as I mentioned earlier, that family-assisted intergenerational type lending as well is a big hit for us. Now, I think the first thing for me to mention, which is a big selling point of ours and why people love using Family Building Society, is that we still have that manual underwriting lending approach that is quite hard to find in today's market. So you've actually got a human being sitting there in front of your mortgage application, looking through it and thinking, how can we lend to this client? Finding the reasons to lend as opposed to the reasons not to lend. So you don't need to worry about computer says no with us. It is that common sense lending and thinking outside the box, which it makes a massive difference. And with having a team of BDMs, you've also got the support of the team at Specialist Finance. We can all puzzle together and figure out the reasons as to why we should lend to those clients. And if we need to, we can refer a case over to our underwriting managers or even our co-directors of underwriting if we do need a slight exception, and if they're happy to support that. that then can support the mortgage application to completion, which is really nice. We don't credit score on any of your clients' cases. Everything is done by a satisfactory credit search, and we use Equifax as our credit reference agency. Now, if the client has got an odd blip in their credit report, we'll tend to overlook that. We may ask for an explanation, but it depends really on what that piece of adverse is there. If I'm going to be completely honest, the bigger areas of adverse we tend to shy away from. So, for example, defaults and CCJs above £500, we would ask that they're satisfied for 3 years. If it's below £500, as long as it's satisfied, and it could have been satisfied yesterday, we're happy to consider that, and that is within policy. However, something that is always stuck in my mind, and I mention it to everyone, and it is just a prime example of how we can make an exception for the right type of case. I had a client who had a £700, it was either a default or a CCJ, and it was registered through a utility company. Now, we all know what utility providers are like. They will just throw on defaults like there's no tomorrow. Now, the client hadn't realised it was on there until they started searching for the mortgage. Obviously, it showed up, it was registered to an old address. They cleared it straight away. But where it was £700, it was falling outside of policy for us and quite a few lenders. But the case itself made sense. There was a good story behind it. You know, this was their only piece of adverse. They had good income, and it was a good loan to value. So when I was going through the case with the broker, I thought to myself, this should be someone we should be lending to, and I'm going to put this in front of an underwriter and really give them the reasons as to why we should lend. And, you know, as I expected, the underwriter was more than happy to accommodate and to make that exception there. So that is just a prime example with, you know, if it makes sense, have a conversation with us, because you never know, we may be able to consider your case for you. Now, moving on to areas of lending, and I would say by far the biggest area of lending, and what we're probably known for most of, is that the lending into retirement criteria. Now, the cases that we see, and you've probably all seen it before, is a client in their mid to late 60s. They've come to the end of the term with their high street lender. The high street lender's saying, no, don't want to know, we just want our money back. They don't want to find them an alternative solution and consider extending their term. Now, the client thinks, well, my only option is to sell the family home or to move on to an equity release mortgage. Well, with us, that's where we come into play, because we're acting as that alternative option for them. Now, the reason why you're going to place your clients' mortgages with us who are of an older age is because of the term that we can offer them. Now, we will lend to age 95 on a repayment basis, and that is fixed terms, maximum age is 90, and we'd offer a 5-year term for that client. With interest only, it does work slightly differently. So it's based on term guidelines, so the life expectancy of someone of that age. So, for example, a 70-year-old, we'd initially offer them 16 years on interest only. So then at the age of 86, we could potentially extend that term by a further 6 years for them. Maximum age on an interest only basis with us is 89, and we'd offer a 5-year term to an 89-year-old. Now, you might be thinking, Grace, you know, that's all well and good. You can lend my client into retirement, you can offer them a long term, brilliant. But how are we going to show affordability? And it's a great question. So when looking at earned income, we will take this to age 75 if the client's either in a non-manual role or they're a professional. If they don't fall under one of those categories, then maximum age is 70. Now, if you want to maximise the term and take it beyond those ages, then that's when we're going to be looking at their income into retirement. Now, we'll accept your standard state and private pensions. We'll take 100% of those, but we want to look at the more quirkier income streams. So what we do is we look at pension pots and UK-based investments. For example, a stocks and shares ISA would be acceptable for us. And what we do is we take 80% of the value and then divide it by the mortgage term to give us an annual income figure to use for affordability. Now, the beauty of this, and what makes us different to other lenders that will utilise pension pots and investments, is one, that we don't actually require the client to be drawing from these investments. And two, you know, we're using a larger amount of that pension pot even when they're not drawing on it. Other lenders out there in the market will use 5% maybe. So, you know, with us, 80% means more income that we can use into retirement without the need of the client drawing from these investments. And we're actually hoping that that criteria is going to be changed and we can go back to using 100%. It was changed, you know, when we hit lockdown, when COVID was about, it was changed to 80%. But yes, the hope is to move it up to 100% soon. Now, other income that we can use into retirement is rental income. All we need to see is 1 year's FA 302s. Don't need to see any more than that. And something that's popping up more and more, I'm finding, is income from a limited company. Now, this would be someone who's got a well-established business. You know, they've got that management structure in place. It might even be that they're a family-run business. They know that they can take a step back at any time. And if they do so, the company's not going to crumble at their feet. As long as the accountant can confirm that they've got that structure in place, then that's the income that you can use to age 95, for example. So we like to think there that one, with the term, and two, the income that we're using, that we really do act as that alternative option for your clients when, you know, coming to the end of the term with their current lender. Now, interest only, we're seeing a lot of interest only business at the moment, and we always have done, but I just feel at the moment, with everything going on, we all know interest rates are on the higher side, and we are in a cost of living crisis. Everything is so expensive. So I think clients just want that reassurance that moving themselves onto an interest-only mortgage, even for a couple of years, it's just going to give them that sense of security that they're able to make their mortgage payments. Now, with us, our interest-only criteria is really simple. We don't like to overcomplicate it. Now, I'm sure you've all seen it before. Lenders will be asking for a minimum income or a minimum property value or minimum equity requirements. With us, we remove all of those barriers. So we could lend up to 70% loan to value with a client repayment exit being downsizing. Sellers and mortgage property is more than acceptable with us. All that we need to see is that the client can comfortably downsize, ideally within a 5 to 10 mile radius. Now, the reason why it's 5 to 10 miles is because we want to be responsible with our interest-only lending. Now, if we said that the client could move anywhere, then to us that would be deemed as responsible, because we wouldn't want the client to have to move 100 miles away just to be able to afford somewhere to live. Now, keeping it within a 5 to 10 mile radius, it's an area that they've always lived in, it's what they know. However, if the client has said to you as their advisor, you know, I'm living here at the moment, but I want to retire and downsize to the coast, it's a nicer way of living and it's a little bit more cheaper, then absolutely we can look at that area as well. We just want them to have that plan in motion. Now, if clients have got other repayment exits in the background, then we can absolutely consider 80% loan to value. This would be the likes of sell of buy-to-let properties in the background, second home, cashing in their pension pots and investments if we're not using all of it for affordability. Now, if downsizing is their only repayment exit, they want to maximise the LTV up to 80%. It is a possibility. Now, that would be possible by them doing a part mortgage and having 10% of it on repayment and the 70% of it on interest only. That is definitely a possibility as well. And they can absolutely mix and match the repayment exits as well. So it doesn't just have to be one repayment exit. Now, we can stress the affordability on a pure interest-only basis. This is applied when the term is 10 years or less. As soon as we go over 10 years, that is when the affordability is stressed on a repayment basis. But that is down for me and the team at Specialists to discuss, because all we ask is you just give us all of the income figures, all of the expenditure and the loan requirements, and then we will run the figures in the background for you and tell you how we can get your clients the growth that they desire. Specialists also got access to our semi-exclusive rates on interest only as well, so you will find that their rates are a bit cheaper than the rates that are available to yourself directly. So it's also another incentive to use them as your packager. Now, self-employed. The self-employed, I mean, any of the cases that we see are definitely not straightforward. They are on the complicated side, but especially self-employed applicants. They're never straightforward, which is great. It makes it really interesting. Now, in an ideal scenario, we would want your clients to have a 2 years trading history being self-employed. And we can look at the likes of limited company directors, sole traders, partnerships. We can accept all of them. But yeah, in an ideal scenario, they will have 2 years accounts to provide us. But to be honest with you, the type of clients that we see and who we can help with are those with the quirky company setup. So it might be that they've gone from sole trader and now they've moved on to a limited company, but they've only done that last month, for example. But they've got 2 years plus of sole trader history. Now that is something we can help with. We don't require them to have 1 year's limited company accounts. As long as the accountant can confirm that they're moving the structure over from sole trader to limited company, and that hasn't had any bearing on the company itself and the income that they're earning, then we are more than happy to help. And what we would do is we would just work from their previous year's SA 302s. Now, in terms of income that we're using for your self-employed applicants, we will use salary and share of net profit or salary and dividends. It says there that we can consider self-employed applicants where they've got more than 33% shareholding. Now, policy states, in my personal opinion, knowing the cases that I've agreed in the past, someone with a 20 or 25% shareholding, the underwriters have been more than happy to consider using their income on a self-employed basis. Now, in terms of using 1 year's accounts or latest year's figures, it's definitely not something that's written into policy, but it's going back to that common sense approach, speaking to an underwriter and see if we can get an exception made. I've had cases in the past where a client, let's say for example, they've got 3 years plus trading history, and we're looking at their last 3 years accounts, and we're going to the underwriters with that. But in the last 3 years, that middle year itself, there was a loss that was made. We know it was a one-off loss, and the accountant is more than happy to provide an explanation for that loss and to confirm that it is a one-off. Then we can go to the underwriters for those last 3 years and explain that the years prior and prior and since that loss-making year, that the company's been really nice and healthy again, and that income is nothing but sustainable, and if anything, going to increase going forward. Then the underwriters should be happy to consider that with that explanation in place. 1 year's accounts is a little bit more trickier to get agreed on. Not to say it's never happened before, because it definitely has. This would be someone who has got a lot of experience in that line of work. You know, they've got their first year's accounts, they're really healthy. We might even be halfway through their second year, and the accountant can provide us year-to-date management accounts or even projection figures for their second year end. Depending on the rest of the story of the case, it might be worth us going to the underwriters and seeking out an exception there as well for those clients. We do look at contractors, so we just require a minimum of 2 year track record. Now, this isn't 2 years contracting track record. This is just 2 years experience in that line of work. Now, it's just a minimum income of 30,000, which in my experience, contractors are earning far more than that. And we will work from their day rate times 5 times 48 weeks. Load. Now, moving on to our family assisted mortgages. We've got two in particular. We've got the joint borrower sole proprietor. We currently call it joint mortgage sole owner, but that has changed. And then we've got our 95% family mortgage. Both work very differently, but out of the two, the joint borrower sole proprietor is definitely the more common out of the two products. Now, this criteria changed literally as of yesterday, I believe, but it states there parents can help children with the affordability, or vice versa, children can help parents. We have now expanded that family assistance and changed the criteria to say that all family members can help. So parents, grandparents, aunts and uncles, siblings, they would all be able to help with this particular product. Now, what makes us niche within the market is the terms that we can offer your clients. So we allow the terms to go up to age 95. with the eldest borrower helping from an affordability point of view. I think Metro's our closest competitor, and they'll take them to age 18. So the fact that you can get an additional 15 years with us does make a massive difference in their mortgage payments. Now, again, another reason why makes this very niche is the fact that we can allow up to 4 applicants and we'll use 100% of all 4 incomes. Now, that applies to all of our residential mortgages, but works especially well with this particular product. Other than that, it runs very much in line with the standard policy. Anyone that's not familiar with how the product works, family members can go on to the mortgage, but they're not on the title deed, so there's no additional stamp duty fees for them. They're just giving them that extra leg up there from an affordability point of view. Now, the 95% family mortgage, I'm not going to go into tons of detail because we just don't have the time, but simply how it works, it's similar to the Barclays Springboard mortgage. A minimum 5% cash deposit required, that can be gifted, and then 20% of the purchase price can be is required as security. Now, that security can either be made up as a charge on a family member's main residence or in savings. Now, the savings has 2 elements to it. They could either put the money into a savings security account and the family members would earn a small amount of interest on that, or there is an offset feature to this product, which in my opinion is probably the reason why anyone would utilise this product. So this product is designed for those clients who, they've got a good income. The income is pretty much making up the affordability. It's 5.3 times in terms of an income multiple. But there may be an instance where that client is falling slightly short. Not by a lot, maybe £10,000, £20,000. They've got their heart set on the property, they don't have any more deposits to put down, and family members don't want to gift that money away because they'll never see it again. Now, with the offset facility, it allows family members to offset up to a third of the loan amount, which is not only going to offset the interest on their monthly mortgage payments, it's also going to offset the amount that we need to assess them for affordability. In any instance, the security and any savings is held for a maximum of 10 years. In my opinion, after the 5-year fixed rate comes up for renewal, you'll be remortgaging onto the high fix. You've already got them onto that property ladder, and then any security will be released at that time as well. And there is also a 6-month unemployment cover, which is completely free of charge to the client as well. I think this is the last point I wanted to discuss in terms of expat lending. Now, with us, our expats are available on a residential and a buy-to-let basis. With the residential side of things, it's quite straightforward, to be honest with you. I mean, there's about 45 different countries that we can lend to. Europe included, Australia, countries within the Middle East, Hong Kong, India, but we do accept foreign currency income. Now, this is either employed or pension income that we can accept. If it is self-employed, it does fall outside of policy with us, to be honest with you. But it's the exact same affordability, what makes it great. You know, there's no specific affordability calculation that is done for this particular mortgage. And the clients can be living overseas. If they want to buy property here to be used as their base here in the UK, it doesn't have to be permanently occupied. It can, as long as they've got the correct insurance in place, then that's all that we're looking for here for them. Oh, just one thing to note actually on that expat basis, you may currently find that it is only available in interest only. That criteria is changing. It's not confirmed when, but it is now also moving on to a repayment basis as well, which will make it even easier for your clients and mortgages to be placed with us on an expat basis. Sorry, Tony.
Don't worry, Grace. That's lovely. That's brilliant. As always, thank you very much. And as somebody who's an avid follower of all Netflix series, you'll know who this particular person is. This is one that we completed a few weeks ago, I believe, and was a bit of a tough one. Broker partners and place of business with. I put this little bit in just so you, just an idea of what can be earned on you using us as your partner in business. He's been putting business with us since 2010, and he's in the last 13 years earned over £300,000 in commission from us for not really doing a great deal. He just has lots of very, very decent clients. Had a really difficult first-time bar application. This 19-year-old was the start of a Netflix series that had just finished, I believe, its first season. He's been signed up for seasons 2 and 3, and also some very lucrative sponsorship deals. So he's all of a sudden seen his money sort of like explode. Is probably the best way to describe it. Other issues. His 2022 tax return showed 25 grand. 2023 showed 150. Believe me, he hadn't drawn anything like what he could have drawn if he wanted to. But he's probably on his way to becoming a millionaire very, very shortly. But he wanted to buy his first property. He wanted to be independent of mum and dad, and he wanted to have a pad in London because he loves the London nightlife when he's in the UK, of course. So it's one of these ones you struggle with a little bit because it's not ticking a lot of the boxes. So this is where someone like the Family Building Society or a lender like the Family Building Society really comes into their own, because manual underwriting, but it's not just manual underwriting. You want manual underwriting with that common sense element and people that actually know what they're doing and have been doing it a while, not somebody who's just going to tick the same boxes as the high street would. Was approved and a case recently completed. Our broker partner earned £3,207 on the day of completion. And you'll hear me say that a lot about the day of completion. But that was just one that was really, really struggling anywhere. He had tried to go direct with the help of his parents and was just hitting a brick wall every single time. And I believe it also tried another broker who also wasn't able to place him. So this is where I say someone like the Family Building Society really does come into their own. So keep them. We're just in the process of updating our Family Building Society. The only lender that we actually have, we completely rewrite the terms. So what we'll issue to you is their product guide, but it's a product guide that we produce. So you should be getting that shortly. Unfortunately, I'm a little bit behind on that one, so that will be done probably by tomorrow, I'm hoping. So that will be out to you. I'll get that out to everybody that attends. Probably tomorrow afternoon, I would hope. So questions. No questions from the delegates, Grace, which means you've either covered everything or they're just too scared to ask a question. So I'll go to the ones you've asked yourself. I don't think you've actually covered these. So with your joint borrower sole proprietor or joint borrower sole owner mortgages, do you require a minimum income from the main applicant?
No. We don't. So this is also another reason what makes the product so great. We don't require a minimum income. In an ideal scenario, we'd ideally want them to be earning in between, £20,000, in and around that. But it's all going back to that common sense lending. If we're looking at a client and we're looking at their job and they're a trainee professional, for example, earning £15,000, the underwriters will look at that and feel more confident in lending to that type of client, knowing that their income is going to increase, as the years go on. So, no minimum income.
Okay. Sorry about the picture that I put up there on the any questions bit. I did that last night. I was trying to follow your previous pictures on each of the slides, and I just typed any questions into Google, and that one came up. So I thought that was ideal. That's how I feel sometimes. That's how my wife probably feels sometimes. I think when she's talking to me, she probably needs a megaphone. Okay, your final question. Oh, hang on. No, we've got a question from Jay. Jay has said, what is your minimum lend?
So 45,000 is our minimum loan amount.
45.
And that's on residential and buy-to-let basis.
Excellent. Okay. And the final question you set yourself is one more being tight. So on your interest-only mortgages, do you apply a pure interest-only affordability calculation?
I do, yes. I did briefly mention that on the presentation. Yes, we do. When the term is 10 years or less, we will stress it as pure interest only. But, it's what's great having, me as your BDM, the team, specialists. We can play around with figures together and see what generates the most borrowing for the client, whether that be stressing it over 10 years or applying the semi exclusive 5-year fixed rate, are all going to be more generous with the affordability calculation.
Okay. And final question, because we're a little bit behind time, not your fault, mine. Donna has asked, family parent / help, would this incur stamp duty first time buyer?
So if you mean from a joint borrower sole proprietor point of view, whether that's parents helping children or vice versa, children helping parents, that wouldn't affect their stamp duty fees because they're not on the title deed there. With the 95% family mortgage, it is just the main applicant themselves that is on the mortgage. No one else is party to that mortgage application. It's just the security charges that we hold in the background. But in terms of them being on the title deed or affecting any stamp duty, that doesn't get affected, no.
Okay, we have got one more being typed. Let's put this slide up because I mentioned Grace is probably the only one that we actually put up contact details for on the slides because she's more than happy to take your calls. Of course, we'd love the business to come to us, but she can help. Gosh, she only covers a particular part of the country, but she's there. Should you wish to, if you have a question or you've got a case in mind. Rachel, I like this one more question.
It's a little bit more seamless as well. If you come to me and you want to discuss a case and we know that it's going to go to specialists, I will write you up your AIPs and you can just send that to the team and say, look, I've already spoken to Grace, it's all agreed, we're good to go, and then you can get the team to get the application submitted then. So it just makes things a little bit more seamless as well, doing it that way.
It does. And Rachel has asked, buy-to-let owned less than 6 months, is this acceptable?
We do have a requirement that the properties are owned for 6 months plus. However, it depends on the scenario. We may be able to make an exception, especially if it's been bought at bridging finance or if they've inherited the property, then that's okay. But it's very much on a case-by-case basis, Rachel.
Okay. Okay, Grace, I think we've done. Oh, sorry, Jay just asked one more question. It's actually the last one, everyone. Do you do shared ownership with housing association?
We don't offer shared ownership, unfortunately, Jay.
Grace, as always, thank you so much. We'll no doubt talk to you very soon.
Thank you for your time, everyone. I'll speak to you soon.
Yeah, thank you. Simon will remove you from the room, but thank you once again. Absolutely brilliant. We will go. It's just gone 11:21. Everyone, sorry, Grace, you were talking.
No, it's all right. I'm just saying bye.
Oh, bye. Okay. Okay, it's 11:21. So I think if we come back I'm trying to find the right slide. Bear with 1 second. Not 11:25. We'll come back at 11:30. Just have a quick comfort break. I'm gonna make myself a coffee. I'll see you then. Welcome back, everybody. We'll move on to our next speaker, who is actually attending. I was just waiting for her to be moved over as a presenter. So I'll start my introduction. So our next speaker from Lendinvest Mortgages is Tatyana Stefanova, who hasn't presented at one of our shows before, but we're expecting this to be as good as Lendinvest always are. And there she is. Hi, how are you? Can you hear us?
Hello, good morning. I can hear you fine. Can you hear me okay?
Excellent. Yeah, no problem at all. Loud and clear. Right. Okay. So you should have received this today by email. It's their buy-to-let criteria guide, buy-to-let rates guide. That will be in your inbox this morning, hopefully. If it's not, then check your spam. A little bit about Tatyana. This is a bit of a
lengthy introduction.
It might take a while, this one. Tatyana's journey in financial services started just over 6 years ago when she moved to Scotland to work as a mortgage customer care specialist at RBS. She has since had the opportunity to deal with a number of different mortgage and investment products, taking on the role of account manager at Investec Structured Products, and then as a telephone BDM at the mortgage lender. She joined Lendinvest in 2020, where she works as a business development manager. She is experienced in dealing with complex lending scenarios and is excited to offer multiple finance solutions to brokers, investors, and developers across Scotland. Outside of work, Tatyana is a passionate motorcyclist who loves a weekend adventure on her beloved Triumph Speedmaster 1200. Exploring winding roads and scenic routes across Scotland is her ultimate escape. Additionally, she holds a fascination for whiskey. Hopefully not, obviously, whilst you're on the bike. Delighting in the intricate flavours of different single malts crafted by local distilleries. When the weather allows, you'll often find her camping, relishing the great outdoors and embracing the serenity of nature, sipping a dram beside the fire. Wow, okay. Sounds great to me. Absolutely ideal.
I thought that will be posted somewhere. So I would have shortened it. Definitely too lengthy of a bio.
No, that's good. That's good. Okay, and Tatyana's claim to fame. Back in her pre-financial services days, Tatyana worked for a well-known Swiss watchmaking company in the heart of London. Their customers were people you often see on TV, as well as high net worth individuals. Because of how often this happened, she eventually got desensitized to it all. They were all customers at the end of the day. A few of the names that come to mind are Arnold Schwarzenegger, Jason Statham, Lord Sugar, and Tej Lauvani, who I wasn't sure who he was, so I actually Googled him, and that's a picture of him. It's just he's the Dragon's Den guy,
yeah,
obviously,
absolutely.
but I wasn't sure of the name. But I think he's actually based very close to where we are. So because they're in Hemel, I believe, his company. But anyway, that's beside the point. Tatyana, over to you. I'll see you in about 20 minutes, and good luck.
Thank you very much. Hello, everybody. Nice to meet you, although virtually. Today's presentation will cover two different topics. We'll start by exploring the market and talking about opportunities that we have in the current market conditions. And then we'll dip into what Lendinvest has to offer. And hopefully by the end of this, you'll get a good flavor of who we are as a lender and what type of clients we can help with. So just starting with the market update and what we are observing in the recent months, obviously to realize what the opportunities are, you have to really take a step back and look at the market and see what opportunities are being shaped. So firstly, and I'll quote what's been discussed at Dragon's Den, you have to find a solution to a problem in order to have a successful product, if you want to call it this way. So we will take a step back and review what the market has been going through. We'll take an overview and see the market conditions at the minute and what's been leading to them, and how that has been shaping the current buy-to-let opportunities and what the outcome is. So starting with the market perspective, and the next slide is a little timeline of what we have been experiencing. And I'm sure everybody has been affected by all of those events one way or another, some more than others. We won't be going through every single one of them in detail, but just painting a picture, we've been through a lot, and it's COVID, the cost of living crisis, the mini budget, all that has had an effect on our economy, on the market, and specifically the mortgage market. But it's not all doom and gloom. Following Hans mini budget in March this year, we're actually starting to see light at the end of the tunnel. And those are just two charts that we've taken from the Office for National Statistics that are really evidencing that the market is changing. We're seeing positivity there and things are moving in the right direction. I was actually even checking on BBC this morning. You may have seen this article, but there has been an update with regards to the economy growth that we are experiencing at the minute, and there is confidence that the base rate will remain the same the next time there is a meeting. So what we're seeing is that obviously the inflation's coming down and things are really shifting in a positive direction, which we're all hoping to see. And despite all the negativity that we've been reading in the news, despite that, the fact that you may observe different local property valuation changes, if you take the market as an overall average year on year, we're still seeing, although quite small, there's still a small growth in the property prices. So what is that actually telling us? As much as there are challenges, from an investor point of view, if you take the property valuation data starting from back in 2005, this is still a good investment because there's still growth there. So people are still looking to acquire properties as an asset and benefit from that growth year on year. As I said, although it's slowing down at the minute, the overall growth trajectory is up the way, which is positive. So following all of this, we have seen a change in the buy-to-let scene and change in consumer habits. And we'll dive into that by using a few of the very well recognized names in the market, in the industry, and what they have been reporting. Starting with Connells, they have observed an increase in the number of rental properties being put on the market, and that increases by 8%. By the way, I'm covering Scotland as a region, and it's very interesting to actually look how individual parts of the UK are being affected differently. As some of you may know, that we are going through a lot of changes in the rental market, and a few legislations have been introduced here. So we're actually experiencing the polar opposite. We have a lack of supply in Scotland and a huge demand for those properties. So it's very interesting to assess every individual area, but overall, Connells are reporting an increase since March. Hamptons, 17% increase again, another positive news story. And then looking at London in particular, we've seen a 39% increase in rental properties going on the market. So there is a lot of supply, which would likely put the rent increase at bay a little bit, and it would mean that there is more opportunities for tenants to find the right place, and there is activity in the market, which is always positive. But you may wonder what's driving that increase in the number of rental properties that are coming on the market. And the logic that most people would follow is that it's likely a result of the increase in interest rates that we've seen over the last year and a half. People that are looking to move to a new home, getting their properties on the market, and perhaps they're not finding that as many people being able to borrow. So the properties may be lingering for a little bit, and then they decide to remortgage into a buy-to-let in order to raise funds for the new home. However, is this something new? It is not. In my experience, and I'm sure in your experience, this is a very common scenario, people raising funds from their existing home to move elsewhere. And what is the different in this situation? It's the number of people who are actually doing this. Because of the high cost of funds, properties, especially those that are of higher value, are not shifting as quickly as they normally would. So the decision is to actually put those properties on the rental market. So that is driving the increase in the rental properties that we're seeing, which on the other side is affecting likely the local rental figures and the potential growth and the income of those rental properties. So what is the result for both ourselves as a lender and you as a broker? So firstly, what could this mean for landlords? Well, if you have home sellers that are very keen on selling the property, you will have a good opportunity of negotiating a good deal. Last year, the year before, specifically in Scotland, I'm sure that's been seen in other areas, people were overpaying way over a home report value. Because the market is now saturated with properties that are not selling, this is an opportunity for our investors to go in and possibly negotiate a bit of a discount on the property, which would, on the other side, allow them to capitalize on a better profit and a better deal. On the other side, demand for rental properties will outstrip the supply, and we're seeing this in Scotland in particular. As I said, we've got the rent cap here, we do have the eviction moratorium, we have seen the changes that are a result of the increase in rent. So we're actually having so much demand, which is pushing the rents through the roof. But on the other side, you have so many people competing for those same properties, which allows the landlords to drive the price for those rental properties, which again allows them to profit from the investment a bit more. So what would this mean for you as a broker? Well, you have a hopefully increase in your inquiries, whether that's from those home movers that are looking to get a buy-to-let or let-to-buy mortgage on their existing properties. You'll see an increase in the demand for your services because of the number of specialist cases that are coming on the market. We've already seen an effect from the cost of living crisis and the habits of increased borrowing in the past, driving the struggles with affordability with people that are looking to refinance. So there's certainly going to be a bigger need for a mortgage advisor, where historically people are used to approaching their high street bank because of how complex things are at the minute, because how complex people's individual circumstances are. You need to seek advice, and that would keep you busy. Now, on the flip side, we've got ourselves as a lender, obviously keeping track of the market and seeing what the struggles are at the minute. And that is shaping the lender's criteria, like we've seen from the other two presenters before me. Fantastic criteria and USPs out there, which gives you an opportunity to always find a solution for your client and place a case somewhere, whether that's with us or somebody else. The bottom line is that there is so much competition that the customer would always, hopefully always, not 100%, most of the time, there will be a solution. If not now, then further down the line, but you will be the person helping them and guiding them getting to that state point, to that stage. I can't speak this morning. I probably need to have another coffee. So diving into Lendinvest, for those of you who are not familiar, we like to call ourselves one-stop shop for property finance. Now, we've started talking quite a lot about lenders setup, and it's really important to recognize how a company is operating and appreciate a company's strengths. Now, as a lender, we externally funded. The names that you're seeing on the screen are internationally recognized. And for us, this is a testament to the type of business and the type of company that we are. Being backed by those very well-known institutions means a lot, and is, as I said, it's a huge testament to the type of business that we do. What is our approach as a lender? Now, we are really focusing on the service. Perhaps stemming from my historic experience in Swiss watchmaking, I often like to compare Lendinvest to a Swiss watch. You have a well-oiled, well-working machine focusing on the quality of the service that you're receiving, and not just you as a broker, but your customer as well. We provide instant quotes through our portals. We provide direct access to our underwriters. Every single person within Lendinvest has individual direct dial. So as soon as you submit your application, whether that is a bridging case, whether that is a buy-to-let or residential application, you will instantly get allocated to an individual underwriter that you can stay in touch with, and that person will help you through the case and help you reach that end stage and offer stage. You can manage all your cases in one place. If you're not registered, please do register. And once you get logged on our portal, you'll see that you have the bridging there, residential mortgages there. So it's all in one place, making it really easy for you to navigate. You're able to keep track of all of the progress of your deals, and hopefully that would allow you to put your time, extra time that you're not spending in admin elsewhere, and perhaps helping more customers. We have built a number of integrations within our system. We use open banking. For those of you who are not familiar how open banking operates, I'm pretty sure it was mentioned in the previous presentations, but it really helps speed the underwriting process. And one of the things I personally quite like about open banking is when you're assessing income, you've gained access once to the customer's banking data, but if you had something that you needed to reassess, you can just refresh it and you can instantly see an up-to-date information, instead of us having to come to you and ask for additional banking statements that are up to date. So you can really see how that shortens the timescales from application to offer. The other things that we're using, and that's just scratching the surface, there's so much tech within Lendinvest, I can't even name it all, but digital ID verification, electronic signatures, just small things that add up and really help you speed the application to offer and application to completion timescales, which is important, especially for time-sensitive cases. And you have a dedicated BDM covering every single region. You have somebody that will always be there to help and support you if you have any questions. If it's something complex, we don't want you to shoot blindly and just go and submit a case. We always encourage people to come and talk to us first and see if it's something we can help with, see if we can refer it to a decision maker, to a credit team in advance, and give you that extra confidence that you may need if your case is really, really quirky. So moving on to our products, we do have 3 defined product categories. The first one being short-term lending. You may know that Lendinvest was initially set up as a bridging lender, and over the years we grew to introduce buy-to-let lending, development finance, and lastly this year we launched our homeowner proposition, which is our baby at the minute. We're growing it. We're so excited to be able to help homeowners the way we've been helping investors. So like I said earlier, one-stop shop, meaning you could have somebody purchasing a property from an auction. We can fast track that bridging application. We will offer them incentives exiting on buy-to-let. We do consider day one remortgaging, which is one of the most common investment model. If you follow any investor podcasts or events, there's the constant talk about the BRR investor model, buy, refurbish, remortgage, or resale. And the quicker you do that, the more profit you gain because you pay less interest. And we can do that for you. Day one remortgaging, you can come to us. Homeowners, that's personally probably one of my favorite topics to talk about at the minute, especially in Scotland. Being a BDM for Scotland comes with the challenges. Firstly, you don't really have as many lenders covering this area. You have the islands, you have many regions that lenders generally don't like supporting. And I'm very pleased to say that on residential basis, we lend everywhere. So there is no area that we wouldn't review when it comes to homeowners, down to valuers' comments. So a few of the top USPs that we say that we've got, and that's again scratching the surface. At the minute, I'll start with the market rent one. We're seeing over the last few months struggles for investors to meet the stress testing with a lot of lenders. So we have, and that's been something we've always been doing, but we started chiming about it a lot more because it's really important to know use of market rent if that is higher rather than the passing rent. And I'll urge you, if you have portfolio investors, if you have clients that you haven't really touched base with, who you know have portfolio of properties, oftentimes those portfolios are not up to date. It's maybe worth checking if the market rent is higher and seeing how you can restructure that and fix them for another 2 or 5 or 7 or 10 years and get them in a better place and making sure that the portfolio is still profitable. We focus on unusual property types. We would cover ex-local flats with ex-local authority properties with deck access. Properties next to commercial is a very common question that I'm sure you also come across. We can fund multiple properties in one building. Like I said, we lend in England, Wales and Scotland, and we also consider HMOs and multi-unit blocks as well as standard properties in those areas. And you could use our flexibility to day one, our flexibility to property type, the use of market rent in your client's advantage. And I feel I'm running out of time. So there you go. I've actually been on time. So thank you very much. I hope that gave you a good flavor of who we are. And I'm really excited to see what case study Tony has chosen to share with you today.
Okay, Tatyana, thank you. I wasn't trying to cut you short. It takes about 20 seconds for it to connect. So I thought you was at the end of that slide. So my apologies. So this case study, a little bit different. I say it's not what you know, which is probably one of my favourite sayings, having been in this industry for so long. We helped a partnership, some partnership clients a few years back with 2 Lendinvest remortgages that we completed. I believe it was on a 5-year fixed rate. So obviously there'd be ERCs if they were looking to settle early. They then had some tax advice because they realised that the George Osborne budget all those years ago was about to seriously affect their income. So the tax advice was from the specialist tax advisor to move it into a limited company situation, which is what they then started to do. Of course, when we first approached Lendinvest, we were told no, had to repay the existing, take it out as if it was a purchase. ERCs were going to be above 30 grand for the two properties. and all going to get a little bit expensive. So I basically, I'm not going to name drop because I can't say who it was, but I contacted somebody that I know very, very well within Lendinvest. We were one of their very first packager partners they took on all the way back in 2017, I think it was, when they launched into buy to let. Known him for many, many years. I sold him the deal, sold him the clients who were very, very high net worth as well. And with the full support of the board, he agreed a one-off situation. They wouldn't charge any ERCs whatsoever. So I saved that client, managed to save that client his clients a substantial amount of money. And they also agreed to pay us the full 1% prop fee, which I thought was very, very nice of them on the new deal too. So which was great. A broker partner on both transactions has now earned 6,930. All he gave us initially was a name and telephone number, and we did all the rest. But that's a situation where just with one phone call, you can save, probably a couple of phone calls, you can save somebody a substantial amount of money. And Lendinvest are a lender that likes to listen. They're not we all know there's some lenders out there that if you tried to sort of like get that sort of flexibility out of them, they wouldn't even know where to start. But this is something we was able to do, and all happy all round. And Lendinvest have since got more business from these clients in their limited company situation they now have. So everyone's a winner. So, and also I believe they're just coming up for renewal for the expiry of the fixed rates fairly soon. So we've got some product transfers to be done too. So, okay, so we go on to any questions. I haven't seen any questions from delegates. There's no one typing, so I'm going to ask Tatyana the question she's asked herself. Are there any rewards or incentives to clients who transition from your bridging products to your buy-to-let products?
That was actually a well-timed question following what you said about your product switch case possibly coming up. We incentivize clients who stay with us, whether you're using one of our bridging facilities or if you're an existing client of Lendinvest, we will offer you a free valuation if the property is a standard one, a physical one as well as free legals for your refinance or transition from your bridge onto buy-to-let, as well as waiving any application fees that may be applicable to your new product switch case or new application, which is the beauty of staying with the same lender for your exit or transition onto a new fixed rate.
Okay, and your next question, do you offer day one, you've already answered this, but I'll ask it again. So do you offer day one remortgage, and what figure are you lending against? Purchase price or market value?
I did touch on it, but I wanted to specifically dive in that topic. It's another favorite of mine. A lot of the time, investors will be limited to how much money they can raise from the property day one, and you could possibly be limited to your initial investment plus your cost of the works. However, if you've actually seen a significant uplift in the property valuation following a refurbishment, and you perhaps purchased it in a discount, it will still allow you to borrow up to 75% of the new market value. So if you are a very well-organized professional investor, oftentimes they have teams of tradesmen working with them. They can go in and out of the property in a matter of weeks, rip it out, get it all done. So you're only staying on a bridge, or if you're not using a bridge, perhaps you're using your own cash funds, or you're using another investor funds, you're only paying interest for a short period of time. On bridging, we have no early repayment charges. We'll only charge the interest that you've used. So you're ready to exit day one and continue that process, which is how we facilitate very rapid growth for investors that are perhaps just starting out.
Tatyana, no more questions. That's absolutely brilliant. Thank you so much. It was lovely to meet you. No doubt we'll
Thank you very much.
some industry do at some stage, or some, I don't know, up in Manchester or any that you might do. But really lovely to meet you, and thank you so much. Excellent presentation. Thank you.
Thank you very
Simon
much.
will remove you from the room, so don't click anything. I have to say this every time, unfortunately, because it has almost happened once. So where someone almost closed down the entire show. So we'll move on to our next speaker, who's coming up. Just waiting for the slides to appear. There they go. Final speaker is Shay Stanford from Allica Bank, and she's just appeared on my screen, which is great. Shay, can you hear us?
I can. Hello.
Perfect. Okay, loud and clear. I'm not going to say anything about no IT issues so far because I don't want basically, we know exactly what will happen in about 10 seconds time if I do. So, or we did. Okay, so you should have received this, everybody, today. This is a commercial mortgage product guide from Allica. Allica, I mean, I know Shay's going to cover this, but Allica launched 2020, and they've become a very big part of what we do. I mean, lending through lockdown, and have really are a very valuable lender to us now, as some of our old commercial sort of challenger banks have decided to either sort of move away from it, or just brought in terms that means that it's fine if you want to raise more than £1 million. But anything under that, they're not interested. So a little bit about Shay, first of all. She's worked within commercial lending for the last 11 years, predominantly for smaller challenger banks. During this time, she's gained experience in property development, completions and sales. 15 months ago, she joined Allica Bank as a central business development manager. Her current role involves building an active and engaging panel of broker partners to assist with empowering its SMEs to succeed. In her spare time, Shay likes football and supports Manchester United. West Ham supporter. Claim to fame. My son-in-law will love this. I'll explain in a moment. Shay once bumped into Peter Andre in a local shopping centre. I put a picture of him up in case any of you don't know who Peter Andre is. My son-in-law, who married my daughter 4 years ago, was so crazy about Peter Andre when he was about 12 years old. He actually shaved. He wanted his hair like him, so he actually shaved with some clippers up his head like that. Just did a tram line just in the centre, which we found photographs of, which we then showed not only his stag night, or his stag weekend, but also his wedding too. So, yeah, big Peter Andre fan. When you say you bumped into him, did you speak to him or?
No, I didn't. I didn't expect to see him at all, to be honest. I was literally just walking in my local shopping centre, looked to my right, and there he was in a perfume shop. So a complete surprise.
Okay. Right, we'll go on to your first slide. I'll see you in about 20 minutes. Good luck. See you then.
Okay, thank you. So yeah, first things first. Thank you, Tony, for the introduction. And as he's briefly touched on, I'm Shay. I'm one of the central business development managers here at Allica Bank, and it's a pleasure to be presenting to you all today. So first things first, I'll run through what I'm looking to cover. So I'll go through a bit about us, our lending criteria, which are our products as well, which you've received the product guide for, in relation to the intricacies of the same. I'll discuss our processes. I'll run through a little bit about what makes us different. And at the end, there'll be a Q&A. So yeah, feel free to ask me any questions at that point. So just first things first about us then. So Allica, we're a new lender and we obtained our banking license in 2019. We essentially focus on giving businesses with 10 to 249 employees the banking they deserve. So we look to empower SMEs, as Tony touched on in my introduction there. We've grown rapidly since 2019, and we won Best Mortgage Provider at the 2023 Business Money Facts Awards. And we won 5 at the 2022 NACFB Awards, including Business Bank and Commercial Mortgage Lender of the Year. And essentially with us, you can expect clarity, consistency and collaboration every step of the way. It's something that's really in our core proposition and something that's really important to us, to essentially be consistent. And our collaboration internally essentially leads in a smooth process for yourselves and your clients. So moving on to our roadmap to centric product development for established businesses. So you'll see this has been split out between credit services and payment services. So we have a savings account, and we've recently launched a business current account as well. In the future, we'd look to assist with things like expense cards and cash management. Moving over to the credit services. So we started off doing just secured loans. So that's very much my area of expertise in the commercial mortgages world. In terms of products, we have a commercial investment product, semi-commercial product, owner-occupied product, and we have an RLS product as well. We do also have an asset finance sector. I'm not an asset finance expert myself, but if you do get any asset finance proposals, do feel free to make contact with me, and I'm more than happy to put you in touch with the appropriate person here in Allica. And then in future, we're looking to offer an overdraft facility and growth finance as well. So moving on to a little bit about our proposition to you. So we understand how important it is to be straightforward in how we work, to act with integrity in what we do, and to deliver a customer value, and to collaborate with you in building a partnership for established businesses. So I briefly touched on this earlier, and that's essentially why we've developed our introducer proposition around 4 core values, and they are collaboration, integrity, delivery, and straightforward. And it's something that we very much live and breathe. So just moving on from that, this essentially means that we're here to talk through any inquiries with you. We do have an auto dip portal online for you to get an automated decision in principle, but essentially we're here to talk through any inquiries with you. So if you have anything quirky or anything like that, you have direct access to a BDM such as myself. So yeah, just feel free to pick up the phone and talk it through with us, rather than, you know, just using the auto dip, especially if there's anything quirky. You'll get a considered and consistent view of an application delivered by experienced specialists. So again, you know, we very much deal with things on a case-by-case basis. So again, anything quirky, just discuss it with us. We do not unnecessarily fire questions back and forth. You'll always know where things stand. So as I touched on earlier, we like to keep things straightforward. We'll take care of your client the way you do, and you can be sure that we deliver on our promises. So it is really important for us to deliver for you, which in turn assists you with delivering for your client. And we have a deep understanding of established businesses and the importance of the introducer channel. So moving on to our lending criteria then. So borrower type. So we lend to UK registered limited companies, LLPs, partnerships, and sole traders. It's currently outside of our appetite to lend to SIPs and trusts. It may be something that we do in future, but not right now. Loan size, Tony did touch on this in the introduction there. So our minimum loan is 150,000 and our maximum is 10 million. And that's in terms of exposure as well, total exposure, that maximum as well. Terms, so our minimum term is 5 years and our maximum is 25. We do also have an interest-only product for a maximum of 5 years as well. Base rate type, so our variable rate is over the Bank of England base rate, subject to a minimum base rate of 1.5%. And we do offer a 5-year fixed rate as well. And our fixed rates revert to a margin above the Bank of England base rate, equal to the fixed rate, less 1.5%. Subject to a base rate floor of 1.5. I know that's a bit of a mouthful, but it will be on the product guide that's been circulated to you as well. So any questions after the presentation, you know, I'm sure you'll be put in touch with myself to discuss further. Security, we always look to take a first charge. We wouldn't take a second charge or anything like that. And that's over either freehold and long leasehold property in England, Scotland, and Wales. And where we're a little bit different, we very much assess debentures and guarantees on a case-by-case basis. So we don't have a one-size-fits-all approach there. We'll very much put a guarantee in place to mitigate something in the proposal, rather than taking a one-size-fits-all approach, as I said. So moving on to property types, this slide here just sort of demonstrates the maximum LTVs we can go up to. We lend against VP. So that's just there for a visual. Again, it's on our product guide. And if you have any questions in relation to the intricacies on that, just do let me know. Now, there are some sectors in which we don't have appetite for. But what I will say is if you do have any questions or you're unsure, do let me know. So anything obviously in the arms, weapons or manufacture or distribution, adult entertainment, gambling, dry cleaners due to the environmental risk factor, petrol stations, animal testing and football clubs, And we have no appetite to lend to businesses operating from the following property types: so religious buildings, nightclubs, or residential park homes and caravan parks. What I will say as well is why I think it's important to pose the question rather than just presuming it falls outside of our appetite, because if it's a dry cleaners, for example, we could consider it if the dry cleaning is not done on site. If the dry cleaning is done elsewhere, then it's a proposal we could potentially consider. Or when it comes to gambling, for example, if your client's looking to purchase a property and let's say there's a Ladbrokes as a tenant, that may be something that we can consider. And when it comes to sort of residential park homes and caravan parks, if it's like a lodge park, for example, that again may be something that we can consider. Or religious buildings, so we wouldn't lend to like a church, but if it was, if there was a security which could have alternate use to it, such as just sort of a standard sort of industrial building, or let's say, and there was a sorry, I've completely lost my words and gone blank now, but we wouldn't lend to a religious building, but if there was a building with like an alternate use, we may look to consider them. So yeah, any questions, just do let me know, and I'll be able to tell you there and then. So moving on to fees and charges. So there's, in relation to our commitment fees, there's a flat fee of £500 payable on acceptance of the formal loan offer prior to the valuation instruction. And we do fully refund that fee at completion. There's an arrangement fee of 2% that can be added to the loan outside of the maximum LTV for any loan up to 3 million. Valuation fee. So our panel is managed, we use VAS panel, and we have a fee scale available on our website. In terms of legal fees, again, there's a fee scale available on our website. And as standard, we rely on the provision of an untaking for our legal fee to be provided by the borrower solicitor, essentially to enable them to commence works. The customer must instruct their own solicitor. We do not offer dual representation. And there's a procuration fee of 1.5%, no matter what the loan. So moving on to a bit about our application process. So as touched on earlier, we do have an online portal where you can submit a DIP through, so a decision in principle. But again, anything quirky, you can approach myself for an illustration, and I'm more than happy to provide that for you. The DIP system, the portal's just there in terms of DIPs for if for any reason, you know, I'm in a meeting and you need something instantaneous, then the option's there if you wish to use it. Once you have either an illustration from myself or via the portal, you can then proceed to full application. After that, the underwriter then reviews the case. They could ask for further information or approve the case. After that's done, there's standard KYC checks that are done on approval. And then after that, we then issue an offer letter. The customer then signs the offer and returns the commitment fee. Then we proceed to the instructions upon receipt of both of those, and then we can then proceed to completion. So yeah, that's essentially just a roadmap of our application process there in a nutshell. In relation to the information required to a decision in principle, so we just need some basics of company and business details, details of the applicant, including their full name, date of birth and address. We'll need property address, estimated value, the borrower's age, and if the property is freehold and leasehold, and some basic information on the property type. We'll need details of the tenant and lease terms. We will use we'll use this information to assess the affordability for an investment proposal. We would need some basic information on the term and repayment profile they're looking to obtain. And then if it's an owner-occupier proposal, we'll just need the financial accounts and a calculation of the EBITDA, and then details of any other income sources there. Now, in terms of the full application, Again, this is on the product guide you have, and what this does is outline the information we need. So you can see on the slide here that it differentiates between an investment and an owner-occupied proposal. And anything ticked is what you need to submit along with a full application. So you will go onto our portal, and let's say it's an investment proposal, for an example. So you need sort of financial information here, information of tax returns, bank statements, business bank statements for the last 3 months, a proposal summary, a property schedule, an alley, bank account details, and source of deposit information. And on the product guide that's been circulated to you, these sections in orange, they're hyperlinked. So all of the information you need, all you have to do is simply click on these orange hyperlinks, and the documentation is ready, available for you there. We're more than happy for you to use your own templates of the same if you wish, but ours are available should you wish to use them. So some points of difference here. So essentially, what makes us different? So we have a genuine focus on supporting established trading businesses. You have experienced BDMs that you have direct contact with. You won't go around the houses if you're looking to contact us. You can have direct underwriter access. So if they have any questions about your application, you can speak to them direct. We only require 2 years financial accounts for owner-occupied proposals. We have a straightforward DSCR calculation, so that is 130%. And as I touched on earlier, our approach to personal guarantees and debentures, we very much assess those on a case-by-case basis. So yeah, and just prior to moving on to Tony's section there, just a few points that I've not touched on in that presentation. So here at Allica, we would require a property to be at least 20% commercial to enable us to assist, and that's in terms of square footage of the property. So let's say if it's a shop with flats above, that's something that we can assist with. Or if it's predominantly residential, theoretically speaking, if it's like a shop with 8 flats above, we can assist. So we wouldn't lend where anything is fully residential. We would need that 20% commercial element. So yeah, that's sort of me in a nutshell. So I'll move on to the next slide.
Shay, thank you very much indeed. Okay, as promised, this is a very, very recent case that completed with Allica, and tick lots of boxes that really, try and place cases like this sometimes you think, where do I start? But we managed to get it through pretty much straight away, agreed straight away. So client, 79-year-old client, first of all, a lot of lenders don't like that age, looking to borrow 75% loan to value, 615 grand, had a mortgage with Interbay for a few years. Interbay then decided that they would not allow a product transfer due to the security type, despite they've been happy to lend in 2018 and the mortgage being conducted perfectly. The security was a car wash and an adjacent sports bar, which had rising damp issues. So really tough, really, really tough. Client spent a lot of time abroad, so was not particularly quick at coming back to us from time to time. And there was issues with a car wash tenant who was a big American company who wouldn't provide any information whatsoever. So Allica agreed to extend the mortgage offer 3 times over the course of 12 months without any change in the interest rate, which is pretty much, let's face it, that doesn't normally happen. Really doesn't normally happen. And they also agreed to use the original valuation, even though it was 14 months old, which saved the clients, as you imagine, valuing that type of security on a long form red book valuation is bloody expensive. It really, really is. So they agreed that as well. So they also agreed an undertaking to sort out the damp issues within 3 months of completion. Because of our packager status with Allica, our broker partner earned 7,200 on the day of completion. If commercial isn't really your bag, if you're a residential mortgage broker and you get commercial deals from time to time, but you don't know what to do with them and you're not really interested in getting involved in them because they are a lot more complex than your standard resi stuff, as you can imagine, then give us a go. I'd say we put a lot of business with Allica, and they are one of our most important lenders on the commercial side. They really are. So that's the first bit. Now, the second bit, I didn't mention this at the start. I should have done, but Allica have very kindly agreed to sponsor an £100 Amazon voucher award, which we give away every month. So I have to ask Shay for a number between 1 and 98. What I have here is a list of all today's attendees. They're all numbered. So I need a number from you, please, Shay, between 1 and 98.
Okay, I'll go with, let's say, 44.
44. Is Sarita Verma in the room? Because we have to get an okay from you, because one of the things is that we do this is that you have to be in the room. There she is. So Sarita, you've just won yourself 100 quid. Well done. Allica will be in touch with you directly to get that organised, and it'll probably be an online voucher, but 100 quid. Nice one. Okay, so just on to, I think we've got one question. I just need to go back a little bit. Bear me 1 second. Okay, so Martin Myers has asked, what do you consider a long lease?
Yeah, so as I said, we lend against freehold and long leasehold property. I do believe, I will have to double check this, but I do believe the minimum would be 30 years remaining. But again, I'll double check that, and I'll happily get that across to Tony so he can give you the definitive answer on that one. Okay,
fabulous. Martin has asked, how do you view the credit profile?
So our underwriters look at the overall background of their credit history. Again, it's something that we very much assess on a case-by-case basis. So there are certain situations where we can consider adverse credit. But again, there are some instances where we couldn't, let's say if they'd missed loads of mortgage payments or something like that. But if there was like a mobile phone a missed mobile phone payment or something that had been settled a few years ago, again, that's something that we can consider.
As with most lenders at the moment, lenders tend to be a little bit more flexible on mobile phones and utility accounts, because the mobile phone companies and utility providers are absolutely useless with their admin, and they're quite often putting people into default when they're not even a customer anymore. So there is a level of flexibility with a lot of lenders these days, but we have got business through with Allica in the past that's had some minor credit blips. I mean, you shouldn't really penalise a client because they've had a CCJ for a parking fine, for example. It doesn't, not really a sort of reflection on their ability to make payments. But if it's something more serious, mortgage payments missed, then obviously it's a lot more difficult. And we do have a home for those types of deals. Martin's also asked, do you look at ex-CVA company?
If you have any proposals, do send them through to me. It's not something that I've looked at in my past, in my time here at Allica. But it's, as I said, and as I touched on in my presentation, we very much consider things on a case-by-case basis, and it's I'm more than happy to run that past one of our underwriters if it's particularly quirky. So, yeah.
Okay, and because of time restraints, I'm just going to ask two of the questions you set yourself, Shay. Do you lend where a security is fully... No, sorry, I'm not going to ask that one because you've already answered it. Do you have any requirements for solicitors acting on behalf of the borrower?
We don't, but I always suggest that they have 2 or more SRA approved managers on the Law Society website, just for the smoothness of and speed of the transaction. So let's say if the borrower solicitor is a one-man band who then goes on holiday, it can just slow down the transaction. So in short, no requirements, but that's something that I suggest.
And believe me, as a company, we insist that they have more than one, because there's nothing worse than someone dealing with something then going away for 3 weeks, or just really not having the time to actually deal with the case because they're overloaded with paperwork and other cases. So we will always insist on at least 2, if not more. So, and how long does it take to receive an offer from application?
How long does it take to receive an offer from? Do you mean complete from application?
Yes, of course.
Yeah. So at present, about 10 days. We are working to reduce that SLA as well, although I still consider that to be quite fast.
Okay.
So yeah, 10 working days from application to receive a full credit-backed offer letter.
Great stuff. Shay, thank you so much for your presentation. Very nice to meet you. No doubt we'll maybe catch up at some stage in the future. Simon will remove you from the room, and we'll move on to the next part, the final part of today, which is me. So we're going to come into some stuff. I'm keeping my phone open because I need to read something from my phone shortly. So here we are. Now the slides have actually changed on my screen, so they all look a little bit weird. So please forgive me because actually it's gone black on my screen. So What I want to talk about today, I'm going to be talking about regulated second charges because this hasn't been covered by any of the speakers. Unregulated buy-to-let second charges and also some regulated bridging loan business and what's currently available. And first slide, quite simply, are you missing out when it comes to second charges? Now, this is why I've got my phone open, because you tend to find if you're not offering second charges and your client has a real need to raise some money, but they don't want to redeem their existing mortgage because of penalties or whatever else, or the rate they've got, or whatever it might be, if you're not offering them, this is what will happen. Your client will go on Google and they will put a search in for loan, and they will then come up with probably the top 6 or 7 price comparison sites. Now, if any of you didn't see this is for you. Financial Reporter yesterday was reporting something that was actually on one of the major price comparison sites, which is Compare the Market, which a question was asked on the site: should I overpay if I have an interest-only mortgage? And the answer was, you'll have to weigh up overpaying an interest-only mortgage very carefully, as it has few advantages. With an interest-only mortgage, any overpayments won't be paying off the capital like it would with a repayment mortgage. This has to be paid in one go at the end of the term, so you won't be reducing the amount owed. That's the advice your clients could be receiving from people who haven't got a Scooby-Doo what they're talking about, quite simply. So that is always my worry, that if someone isn't offering a product to their customers, is it a situation that are then going elsewhere? And let's face it, I mean, pretty much all the price comparison sites now on second charges, for example, only use one broker. They only actually refer that business to one broker, who's the largest second charge broker in the country and is owned by the 2nd or 3rd largest mortgage provider in the country. So what will happen to your client once they get into that system? Because they have gone direct. Will they be approached for other products that you would normally sell to your customers or offer your customers? So it's something you really do need to have this as one, like in your toolbox as such, as a product. We have 17 lenders on our panel. I've been involved in the second charge industry now for 40 years and a few days. And because of that, when lenders are looking to launch, they quite often, 9 times out of 10, they will come to me and say, we'd like you to be on our pilot to launch this, because we know the feedback you're going to give us is going to be truthful, because I also tend to still be at the sharp end of the business. Don't just sit in my ivory tower counting money. I do still tend to get involved in cases because that's what I enjoy. So look for us for feedback, but they also know our cases will be packaged properly and they can test their systems and do what they need to do. If you use a mortgage club for direct lender access, you'll be lucky if you see 4 lenders. And there's one mortgage club at the moment that's advertising lenders, one of which stopped actually lending in 2020, and it's still showing up on their portal. We have another lender launching through us exclusively, and 2 more launching once their FCA permissions are granted. And I believe certainly one of them wants us to be on the pilot to actually test the systems. So that's coming up soon. Affordability, the biggest thing we're probably all facing at the moment when it comes to mortgages. All seen some absolute horror stories. I mean, we had one client last January, who came to us looking to buy a property, hadn't found a property yet, but wanted to know how much he could borrow. And we came up with a figure, I think it was just over 700 grand. By the time he came back to us, which I think was August or September last year, that reduced to under 400,000 when he found a property. So pretty much he's wasting his time actually looking for the properties, looking at the property he was looking at. It's become a massive problem, affordability, for everybody. We're finding lenders now are trying to be more lenient just so they can still get that business in, but there's seen a reduction across the board. Affordability is much more relaxed than second charges, with multiples up to 6 times income readily available. 8 lenders do not use income multiples at all whatsoever. It's purely based on affordability. ONS stats are used to calculate affordability, but lenders have realised that ONS stats can't be relied on in many cases. Did you know that it's more expensive to have a mobile phone in London than it is Newcastle, according to the ONS? I didn't realise that O2 and Vodafone actually discriminate against people living in London. Maybe they do, but I wouldn't have thought it's actually the case. They charge a tariff. They don't care where you are in the country. But according to the ONS, they do. Most lenders allow these ONS stats to be overridden, which is very important. So if it says that as a family of like husband and wife with 2 kids, and their shopping should be £300 a month, as an example, probably a lot more on that now. But the applicants have declared that it's £250. If the bank statements, if they ask for bank statements, which they quite often don't, they will quite often allow that to be overridden. If the client has stated this is what we spend, let's face it, we don't know what anyone spends on their shopping. We don't all go out and buy a fillet steak every day. Depends on what you eat. So if they feel it's justified, they will allow it, quite simply. Security and loan to values. Almost all security types are acceptable. High-rise flats, non-standard construction, ex-council balcony access. And I always leave this one in still from World War II warships. We did write a loan a while back that was actually made from World War II warships many, many years ago, obviously, and still had the steel rivets sticking out. And this was in northwest London, in quite an affluent area. This was obviously the portion that was let out or given to the council to actually let out, but it was the most unusual property I'd ever seen. It was almost entirely made of steel with the rivets. So, but we have places for that. Not all lenders will accept it, obviously, but we do have places for that type of security. Lenders willing to lend up to 100% loan to value, sometimes even more. So for those clients who have obviously really gone to town on the credit cards over the past few years, there is a route and an outlet for them, because some people now, as we all know, are really, really struggling badly. And over 50% of our cases use a home track valuation, so fewer delays. It's not uncommon. I mean, the quickest we've ever got a deal through using a home track valuation, if you don't know what a home track valuation is, it's an automated valuation model. So it's basically a computerized, or it's an online valuation that we obtain. We had some years ago an application in on a Wednesday evening that was actually a family member of mine who I went out to see that evening. The husband had gone a bit mad on the credit cards without the wife knowing, and they needed to raise some money pretty quickly because all of a sudden he realised that he couldn't afford it, and what he'd spent the money on he didn't have anymore, so he couldn't sell anything. So I went and saw him on the Wednesday evening, submitted it to the lender on the Thursday after I got the automated valuation done. It completed on Friday morning. If the lender had been a bit nearer, I would have done it. It would actually completed within 12 hours, probably. Oh, about 24 hours. That's how quick they can be done if there's an automated valuation. So there are fewer delays. Adverse credit history, there's far more flexibility on with second charges on CCJs, recent missed payments, defaults, etc., etc. Debt management plans can be left in place because it might make sense. If someone's paying £1 a month for the rest of their lives on the debt management plan, why would you want to replace that with more expensive debt? Of course you wouldn't. And most second charge lenders do not credit score, which is very important as well, because you're penalising someone twice if you take a credit score into the deal as well, because it's the adverse credit that determines the credit score quite often, as far as Equifax and Experian are concerned. Debt consolidation. Now, over 80% of second charge loans are for debt consolidation, because it is a big thing at the moment. And again, even within my family, I've seen that they're living the high life with rates that are being charged. So buying cars, furniture, credit cards. Yeah, we can afford it, no problem at all. But all of a sudden, rates have gone up, payments have gone up, rents have gone up, mortgage payments have gone up, everything's gone up. And it is a situation now where some people are quite literally, there's no holidays planned for the foreseeable future. They cut down on the shopping. They're not buying the kids new shoes every 3 months. They have to wear them for 6. It is really, really tough. So second charge lenders have actually, because this is one of the big things, I mean, in days gone by, before we had this capability, what you sometimes find is that someone would want to consolidate all their debts. They get the money in their bank account, and what would they do? They would go out and spend it. The worst case I ever heard of was a client, this wasn't one of ours, but a client who received 25 grand and then went straight down the casino that night and blew the lot and was then paying that debt over 15, 20 years or whatever it was. So, but these days, what second charge lenders have now developed is the capability of repaying the debts direct as required by that's what the FCA wants to see. Not just the client getting it and being responsible for doing it themselves, because quite often they can't be trusted or anything else. So lenders actually do it directly. And with everything that's going on with interest rates, energy bills, general cost of living expenses, you could be the lifeline, because if you don't know your client or tell your client you have this product as part of your, as I say, your toolbox, they will go online and do it. They will find someone else to do it, and they will go to one of the massive sausage factory brokers who will charge your client a fortune, because leads from the internet, believe it or not, are normally around £100 a pop. And that's the reason why they're charging the big fees, because they're not getting every deal through, nowhere near. So they have to pay that. That's why their initial outlays is just paying £100 just for that lead that will more likely never go anywhere at all. So you will be the outline, and it will be cheaper. a lot cheaper. And I mentioned here about what I call the 9/11 effect. Now, this was very much back in 2001 when 9/11 hit. I sat at my desk and I've got my 140 odd employees, and I'm thinking, oh God, this is really going to go. This is only going to go one way now. The whole market's going to die. It's going to be awful. It's going to be terrible. Exactly the opposite happened. People just came I think just decided, you know what, we might not be here next year. So I'm going to go out and I'm going to buy that new kitchen. I'm going to do this. I'm going to do that. I'm going to take that holiday of a lifetime that I've been planning. I'm going to go on a cruise. I'm going to do whatever I want to do. And we've seen very much the same since COVID, where people have thought, you know what, I might not be here in 2 years' time. I'm going to go out and spend the money that I want. But of course, now we've had COVID, we've had obviously other issues as well. And then all of a sudden we're stuck with everything increasing dramatically, and people just can't afford it. And it's the debts that are weighing them down. People are deciding, should I make my mortgage payment this month, or do I pay my HP on my car, or should I pay my credit card? Hopefully they're paying their mortgage. But this can help if you get in early enough. It can actually help them save, in some cases, thousands of pounds each month on what they're currently paying, just by sorting out their debts. It's not for everybody. Some clients do need to go down the debt management route. Some clients can go down the remortgage route, but doing nothing at all quite often only goes one way, which is an irreparable credit profile, and a client you can't really do too much with for any time in the distant future. And buy-to-let second charges, you're going to have clients that you've been writing buy-to-let mortgage for. They've more than likely got 5-year or more fixed rates because of the way the market has been on affordability over the last few years. But of course, they've got expenses to pay, and especially for those clients who are probably sitting on very low loan to value. What they don't want to be doing is refinancing and paying ERCs, which of course is going to increase their rate dramatically. So we now have 8 lenders that are in this particular space who are doing second charges on buy-to-let properties. Some of them will lend on HMOs, a couple will lend on multi-unit freehold blocks, but this is now a space that's very, very active. So we've got these 8 lenders. If you go for a mortgage club, you won't be able to access more than 2, quite simply. And top slicing is also available from some of our lenders now. So they don't just look at the rental income, they look at the client's overall picture. And it just means we can get so much more business through. How we source second charges? Well, we developed our own software all the way back in 2016, because when second charges became regulated by the FCA, I saw that there wasn't any software out there at all. And forget the 3 main sourcing systems, because they're pretty much dominated by one broker again. But they're not updated early enough, and they're also not that accurate. And we did find with one of the sourcing systems, we managed to have a look through the back door to see exactly what they had there. They were missing 60% of the products in the marketplace. 60%. So not offering what's actually available from the entire market. So we developed our own, called it Loan Quote, designed and updated by me. I'm quite lucky now because we've now Big Brother's back on, so which I absolutely detest. So my wife watches that, and I'll sit with a laptop in front of me and I'll update whatever I need to update that might have changed late in the day, so it's ready for the following morning. And it is updated sooner, obviously, but it's also more accurate. And the broker partners that use us on second charges absolutely love it. How you can advise on second charge. So if you want to give the advice yourself, you can do. It can be a complex market, but it's not too dissimilar from a first charge. But there are obviously other requirements that you would never get involved with a first charge. But we can give you access to every lender in the marketplace, first of all. Help you source the best product using our unique software. Help you with file compliance, instruct the surveys, issue consent to second charges where required, because we've done thousands of them over the years. We package the case on your behalf and check all documentation, pay you the income on the day of loan completion, no loss of control, and we don't charge a packager fee. And in some cases, we'll pay away part of the prop fee as well, and with most lenders over a certain loan amount. But we don't say, if your business model is you charge 495 quid to your client because they're a long-term client of yours and you look after their protection needs as well, why would you want to put them to somebody who's going to charge them potentially up to 5 grand as a fee? You keep control of the fees and we don't charge anything at all. And this is a little bit about what people are going to say. This is where I normally take a little sip of water. I'm not going to read all 3 of these. 2 of them are very, very recent. I always say the first one I always like to say it's not an exaggeration to say you are a tremendous person. This is feedback from the clients of our broker partners where we gave the advice. And the particular person, Kirsty, has now been in the marketplace offering second charges for 26 years. I don't know of anyone of that level of experience in the market. And Kirsty heads up my regulated team. So that's the type of person you're dealing with. Our second charge panel, not going to go through all those, but as you can see, literally everybody that is involved in the second charge market, and with more to come. And how much you get paid. If we give the advice, we pay you 4% of the advance up to maximum 2.5 grand, which is paid on the day of completion. If you give the advice, 100% of the fee you wish to charge a client, and usually a share of the lender commission if it's over a certain amount, paid on the day of completion. And we always pay on the day of completion. One caveat to that is I do need your bank details to pay you on the day of completion. We were asked the question a while back, why haven't you paid me? Because we don't have your bank details to pay you. But always paid on the day of completion. And I can give lots of examples if you need them of that. I'm just looking at the time. Recent example, I was in hospital beginning of September for 4 days. I was paying brokers from my hospital bed. Why not? I was bored out of my brains. I had nothing else to do. I wasn't supposed to because I was on some fairly heavy duty drugs, but I did. Because we don't have a cash flow problem, I'm not going to cause you one, quite simply. Regulated bridging loans, business absolutely booming on this. Our most recent deal we've had is for a professional footballer that plays for a Premiership team that's found the house of his dreams, but can't sell his existing house, even though he's on a ridiculous amount of money every single week. He hasn't got the cash to actually do it off his own back. So he's come to us through one of our top broker partners, is looking to do this, and we were able to get him a quote. That's the one I was quoting on Sunday night, last Sunday night at 10 o'clock in the evening, and he's now just waiting to hear whether his offer's been accepted, which we believe it will be, and then that one should sell through. But that's the type of, it's not just for people that maybe haven't got, struggling clients. This is it's literally a product for everybody now. So if you've got clients that are looking to refurbish their home prior to sale so they can get a better price for it, regulated bridge loan is a great product. It can be used for almost any purpose, literally almost any purpose, but mainly used by older borrowers for downsizing, we tend to find. That is the main, probably good 50% of the regulated bridging business we get is for that purpose. And it's a very, very simple product. There's no monthly repayments to be made, anything like that. So there's no affordability calculations. And because we've got whole of market, which I think our next slide might actually show who the lenders are. No, it's not. It goes into this one. That's the next slide. Again, what we decided to do was to, when bridging loans have always been regulated, but because if they're a first charge, but there wasn't any software out there that you could quote. So we came up with our own. Again, I designed it, I update it, and it's more accurate than the 3 other sourcing systems out there. Updated soon. It isn't available to everybody, by the way. It's something we are looking to incorporate into our website when we get the time, because I don't want to become basically a sourcing system provider. That's not what we're here for. But this works absolutely fantastically because it immediately allows us to compare all of these lenders. Now, if you can imagine, you have to do this manually. That's a lot of work. Looking at the rates, and it's not just the rates; it's the fees, it's the everything else we have to take into consideration. But our system allows us to do it immediately. And if you come to us and say, Tony, I've got a client looking for a regulated bridge, he just wants an idea of what the rates will be, just by getting a few minor bits of information out of you, we can give you an answer within 90 seconds in writing. So you can go back to your client and say, this is what's available. Is it one for you? If they say yes, we can get things moving. Our service we offer, packaged, where we give the advice, introduced only, where you give the advice. We basically put that across our entire product range. The reason we do that is because we consider, even if a deal is not regulated, we still give it the same duty of care as if it is regulated, because it's much easier to train my staff into actually doing it that way. And that's why I think clients appreciate us so much, as well as our broker partners do, because that's the way we operate, and always have done. And it's why we're different. It's not the products we offer. We offer the same products pretty much, other than a few semi-exclusives or the occasional exclusives we might get from a lender. So it's definitely not the products. We offer the same as everybody else. It's our lender relationships. One thing about being in this industry so long is that I've grown up in this industry with a lot of people now that are CEOs, directors, high-level people that I've known for many, many, many years. In some cases, 35 years. If it's a situation where we get a case that's a bit sticky, I won't phone the underwriter, because the underwriter's job is basically to underwrite according to terms. I'll speak to my contact at the lender, which is normally at director level, and there's an example coming up fairly soon, and explain it to them. I was an underwriter once myself. If I decided, especially if I didn't like the broker, that I didn't want a particular case to go through, I'd take it to my managing director and I wouldn't sell the deal. And he would say, no, I don't fancy that, I'll decline it. And he would do exactly that. It depends on how the deal was presented to that director by the underwriter. If I would go in and say, yeah, this is a deal you should do, he's far more likely to do it. So that's why I speak to the director directly, because I cut out the underwriter and what they might, any sort of like misgivings they might have regarding the case, tell them what the case is, tell them warts and all, and probably 70% of the time, I'm successful with it. And why we're different, it's the people we employ. A minimum of 5 years experience in financial services. I mentioned Kirsty with her now, 26 years. She's not the most experienced member of my staff. I've got Joe, who's been doing this now 28 years. That's the type of people I want to get in. You don't want to be speaking to people who've only been in the business for 5 minutes and really don't have a clue what an LTV is, for example, which I've come across in the past. You want to be dealing with people who know what they're talking about, and you finish that phone call with them and you think, yeah, okay, I'm confident that that person knows what they're doing. Mature with life experience, I think, is absolutely vital when it comes to employing people, because what you want is someone who can actually speak to borrowers and broker partners as an equal, and not somebody who's going to sort of talk in text speak, for example. Or as with one employee we had several years ago that I mistakenly employed, was trying to pick up the telephone because she'd never actually spoken on a telephone that had a cord on it, believe it or not. Mobile phones, you'd never get off it, but not a telephone with a cord on it. On the rare occasion that something goes wrong, because they've been doing it so long, they'll recognise it, and they have the experience to deal with it. That's why we don't get any complaints. I think the last complaint we got was during lockdown, and the complaint was that things weren't moving fast enough. Well, unfortunately, the lender furloughed half their staff, but the other half were working from home, didn't have any sort of like oversight on what they were doing, and it was taking 30 days to get a response out of them. So of course it was going to take longer. But the complaint was because her brother was was actually within financial services. He said, make a complaint and they'll probably reduce your broker fee, which eventually we did. That's the sort of thing you're up against. But we don't get complaints because my staff deal with people properly. And it's not unnumerous awards from the press. Those of you who watched this before know that I actually detest the awards system in financial services. Lenders, yeah, we can all vote for different lenders if we're allowed to vote, of course, because some now have panels. I've seen the panel for one awards due that's coming up fairly soon, and half the people that are on there are thinking you wouldn't even know whether a broker or a lender is actually any good or not because you're not involved in our industry. You're in something completely different. So confuses the life out of me sometimes, but I have seen awards being bought in the past. I think we probably all have examples. I've seen awards being purchased on the basis of how much advertising is being like booked and paid for, and that's not the way it should be. Or even sometimes you might find you go to an award, if you go to awards dues, just look at the sponsors and look and see how many of the sponsors then win an award. Uncanny, really is absolutely uncanny. Worst example I think I saw was many years ago at a trade body awards do, is that the sponsor for the event was up for 17 of the 18 awards. And the only award they weren't up for was a Lifetime Achievement Award, which they obviously couldn't be. But 17 out of 18, now that's wrong. Absolutely wrong. It's how seriously we take compliance and prevention of financial crime. I've shown slides in the past that are given us to the NACFB when they've done the compliance visits with us, that quite simply say we are an absolute country, in the words of the compliance officer, a country mile ahead of our competitors when it comes to anti-money laundering and know your customer, because of the systems we've got in place, which have now been taken on by 3 separate lenders. Because it's not all about electronic. Electronic is fine, but it's not the be-all and end-all. We've seen cases that have actually passed electronic ID and they've been fraud, and we found them. Why did we find the last one? Because I realised that the client was trying to use a Royal Bank of Scotland logo on a credit card that they discontinued using 10 years ago. I knew that. My staff didn't know that, but I knew that because I know what RBS's logo looks like because I've got copies of them all on my system somewhere. But that's the sort of thing we look out for. But that had actually passed EID, electronic identification. So it's how seriously we take this, and we do not get caught out, as far as we know, when it comes to someone trying to do a naughty. What else can we offer? One underwriter from start to finish, commission paid immediately upon loan completion, as I touched on earlier, and we do this. As long as we got your bank details, we do this. and no commission clawbacks, as long as it's not fraud, which hasn't happened in donkey's years, and as long as the client doesn't cancel the agreement. If the lender allows 14 days to cancel, for example, which many lenders do, that they don't cancel the agreement, and then we get a clawback ourselves. What else can we offer? I've already mentioned loan quote and bridge quote. Commercial quote is probably our most used sourcing system within the office, because this covers all of the commercial lenders we have on our panel, plus also all of those buy-to-let lenders who don't appear on Mortgage Brain, 27 Tech and Trigold, or whatever they call themselves these days. And what this quite simply does, it assesses the rental coverage, it assesses the LTV, it assesses pretty much everything other than the adverse situation, which we can obviously do manually because we know what the criteria is. And if, again, you phone us and say, I've got this commercial deal, just wants an idea of what the rates are, 90 seconds later, you can have an email on your desk or on your PC that will show you exactly what's available, what the rates will be, and just saves so much time. It's unbelievable. Our products, literally everything that's secured on property, except for equity release, which I don't really want to get into. So I allow, obviously, others. We've got lots of equity release brokers who give us business, but it's not something that we offer ourselves. And we recently launched into probate loans as well, because that's becoming increasingly popular, although there might be some change to inheritance tax possibly in the future, depending on which government's in. So they might be a thing of the past, but it's something we offer at the moment and do on a fairly regular basis. Second charges, I've already shown that, haven't I? Yes, I have. So I don't need to cover that one. Case study, right? Roma Finance, mentioned this one earlier on. This was a client that we completed bridging finance for in 2021. 20-bed property that had planning for a 10-bed HMO just outside of Heathrow. We arranged 11-month bridge for 2.15 million and was arranged with no broker or packager fees. Broker partner earned £21,000 on the day of completion. In November 22, client approached us again. Unfortunately, the situation with the local authority regards to planning, they were so far behind with planning applications that they still hadn't seen or actually visited the planning application 12 months later. So he approached us again, and Roma, with no qualms whatsoever, allowed us to rebridge and didn't penalise the client. And that is very, very important. We gave the advice. Our broker partner earned 25 grand on the day of completion on that one. And guess what? Client's so happy with the way things have gone so far with ourselves that he's now, we're now arranging his exit onto a term product with Shawbrook Bank. And that will earn our broker partner again, probably in the region of 25 grand paid on their completion. But Roma on that one have been absolutely fabulous. They really have been a brilliant lender. And I can't say that for all bridging lenders out there. Some of them really, and that client will probably be bankrupt by now if they had their way. This was another case study, so I'm keeping a close eye on the time at the moment. 82-year-old expat now with his son living in Israel since 2001, refinanced 19 properties, 2 with regulated tenants, one needed 6.4 million to repay Nationwide, who were no longer in that in that lending space. 5 properties still had mortgages that were repaid up to 20 years ago. This is how bad the solicitor was that had been acting for the client. He'd basically just been taking fees from them, not doing the work, because he was a one-man band, unfortunately. So we refused to deal with him. Lease on one flat should have been registered in 2006. I found out when I got involved in the case that he'd never actually issued the paperwork for the lease to be registered, which was horrendous, absolutely horrendous. There was one property offer that was offered as security by their property manager, who was also taking plenty of money off them. On a property that was sold years ago. That was actually on the list of, even got to the stage where we tried to get a valuer to value the property. And it's like, well, hang on a minute. Tenant or the owner wouldn't let him in. Why are you trying to value my property? ASTs in the wrong name, ASTs that could not be located, properties that weren't insured. Most difficult case I've ever dealt with. I had to get heavily involved in this because it was a catalogue of absolute awfulness across the board. It really was. Everyone who seemed to be involved with this client wasn't fit for purpose and shouldn't have been doing the job. Broker partner earned 45 grand from that case. Did absolutely nothing other than phone me every day, probably for the last 3 weeks before it completed, because he knew how much he was going to earn. I won't actually go into what they said. We are slightly short of time, but they're basically, if I give you more than 5 stars, I would. This is what the broker partner on that particular case said. Last case study I'll do is title borrowers aged 86 and 82 came to us in the middle of lockdown and couldn't understand why we found it difficult to arrange finance for an 86-year-old on buy-to-let properties during the middle of a pandemic that was obviously seriously affecting the elderly population. Refinance of 18 properties, all in the same village. So slight problem with concentration of properties. Some had no EPCs. Almost all were under rented. Some of the tenants were still paying the same rents as they were paying 10 years ago because Lord and Lady didn't want to make it look like they were short of money. The second most difficult case I've ever dealt with, purely because of the type of borrower that we had to deal with. Broker partner and 30 grand completion. And we are completing today the first of the refinances that we are doing on this to put them back onto where they should be. They were missold, this mortgage, the first mortgage, many years ago by a company that will remain nameless. Absolute disgrace. And that particular broker who arranged the first one earned £117,000 out of it and paid the introducer, as they would call him, £7,000. I won't go, actually, I'm running so short of time. I'm just thinking I won't go into this. This is basically what you know. It's not what you know, it's who you know, but you probably all heard this one before. One phone call actually to a director at a lender, and quite simply, we managed to get through 4 or 5 mortgages for someone who had a Proceeds of Crime Act charge against all of their properties. I won't go into it because we've not got the time. Want to submit a case to us, complete our feedback form that you'll have shortly, together with the type of inquiry you have, and we'll call you back. You can complete a decision in principle form we sent you. There's one for every product. You should have that hopefully today. Go to our website, specialisthub.co.uk. You can submit inquiries online, or just pick up the phone, go old school, pick up the phone and talk to someone. My staff are all awaiting your call. I've got a question come up, which I'll ask and I'll answer in a short while. LinkedIn, please follow Specialist Hub on LinkedIn. I'm trying to get to 1,000 followers for Specialist Hub before the end of the year. So if you would follow Specialist Hub, I'd be eternally grateful. You will probably receive, if you and I are not already linked, you'll probably receive a request from me as well. So I'll be delighted to link up with you on LinkedIn if that's the phrase. But please follow Specialist Hub. You're already registered with us, so you don't need to register with us today because you're already on the system, because you've done that. But we would need an agency application signed by you before we can pay you commission, not before we receive business from you, before we can actually pay you commission. So you should have one of these. These are downloadable from our website as well, should you need one, or just give us a call and we can send you one by email. Next Specialist Mortgage Web Show is the 9th of November. It's our last one of the year because we're taking a month off in December. None of you want to watch people talking about mortgages in December, let's face it. So we have Quantum Mortgages, Dudley Building Society, Selena Finance, and Glen Hawk will be talking, as usual, 4 completely different subjects. And our full list of 2024 dates will be launched shortly. We're just deciding on when we're going to probably do exactly the same again, February to November. Pretty much the same format, different speakers. Lots of lenders now approaching us to speak at these shows because they are free to lenders as well as delegates. They're not a little profit-making centre for us. We do these because we find it's a great way for people to learn more about the specialist finance market. And you can register for as many as you like. That's always very important. If you want to register for every single one next year, you can do. 25th of October, 2 weeks from today. For those of you, as I mentioned earlier on, for those of you that did see Robert Sinclair talking back in May, I think it was, this is his follow-up, Basic Consumer Duty, how did it go? You can register at the end of today's show or go on the website. And because these have been so successful, our next one after that, we're running one on the 22nd of November. This is Colin Sanders. Colin's history, he's currently CEO at Tuscan Capital, who are a small bridging lender. Prior to that, he was CEO of Omni Capital Partners, which, if those of you who've heard of the Candy Brothers, that was their lending arm. And that was a very large business until the two brothers fell out. Former CEO of Money Partners, who was a lender that launched in 2004. And then, unfortunately, was one of the ones we lost in 2008. His real claim to fame is he was former CEO of GE Money Home Lending, which was formerly known as iGroup. This man really does know his stuff. He's been a mate of mine since the 80s. And I urge you not to miss this one. Register for it because it's going to be great. It really is. So that's coming up in November. This is what's coming up next year. And these are the sort of people we're now attracting to our Sutton the Specialist shows. Simon Knight, if you've not heard of him, he's the CEO of Lenco, the best lender you've never heard of, is their description of themselves. Former CEO of GMAC RFC. So, again, someone who really knows his stuff. Josh Knight, no relation, Sales and Marketing Director at Octane Capital, one of our favourite bridging lenders. Roger Morris, Sales and Distribution Director at Tandem Bank, who's already done, I believe now, 2 shows with us. I think it's 2 shows. Or was it 1 show? I can't remember. No, it's 2 shows. with us. Everybody knows Roger in the marketplace, got 25,000 followers on LinkedIn, so everyone should know him. But he really does know his stuff. Very, very knowledgeable within the EPC situation, but he'll be talking about something different next time. There's a good chance he might actually appear twice next year, because this is what he loves to do. And then coming up, also, we've got Anna Lewis, Commercial Director at Castle Trust. I've known Anna for many, many, many years. And then I put silhouettes here because we've not actually agreed it yet, but we've got two people that have approached us, or two high-ranking, one's a managing director, one's a sales director. So hopefully by this time next month, I'll be able to actually put a picture up of them and exactly who they are and what they do. So that's coming. But this is what we're attracting now. We're being approached by high-level people within big organisations for our Sutton, the specialists, because they've seen them online and they can see what they're actually about and what they can do. And these are very, very popular, very, very popular. Okay, feedback and giveaways. Any moment now, there you go. Straight away it appears. Don't click it yet. Click here and leave feedback. That little orange button has appeared. You can download any of the giveaways we've got, which is GDPR compliance, product commission. You can register for shows, Sutton the Specialist, future specialist mortgage web shows. Well, there's only one up at the moment, but the others when they appear. So don't click yet. Your CPD certificate will be emailed to you by close of business tomorrow. And if you don't receive, once again, I'll just stress this again, please check your spam first, because in 99% of cases, it will be sitting in your spam. Then give us a call if it's not in your spam, something's gone wrong, we don't know why. Feedback, please help us out. Google or Trustpilot, either or both would be great. If you like what you've seen today, leave us a review on those, always greatly appreciated. Hopefully Trustpilot will not think it's actually a fake email like they do from time to time and actually allow it to go out, they should do. But any feedback you can give us is fabulous, and we thank you in advance for that. And a big thank you again once again to today's sponsor, Roma Finance, and a big thank you to Allica for sponsoring the £100 Amazon voucher. And I was asked one question which has just disappeared. Martin has said, do you equity release where you give the advice? And if so, we don't offer equity release, Martin. That's the one thing we don't offer, because I don't want to get into that marketplace for various reasons. But yes, we don't have a commission split. There you go. No other questions. Someone's typing, but everyone's saying great show. Thank you very much for that. One more slide to come, and it's 40 seconds to 1 o'clock, so that's what I call timing. Enjoy the rest of your day. We hope you'll join us again really, really soon. Thank you very much for attending. Thank you.